Hi guys. Now in this class we'll see the remaining two problems from this working capital management, and we'll move on to the next unit, that is receivables management. So still problem number 6 and problem number 8 are left in this working capital management, which two are very it's like examination problems. You can expect these kinds of problems in exams. So problem number 6, first we'll finish off problem number 6. Estimate the requirement of total capital of the following project with an estimated production of 250 metric ton per annum. So total units of production is 250 metric ton per annum of chemical X. Product chemical X has been produced and production quantity is 250 metric ton per annum. Presently, presently imported and which can be entirely sold at the rate of its landed cost of 8,500 per metric ton. That is, each product can be sold at the rate of 8,500 per metric ton. So you are also required to find out percentage of yield on investment, percentage of profit on sales, and rate of cash generation per annum before tax. So not only you should find working capital requirement, you should also find these three things, that is percentage of yield on investment and percentage of profit on sales. What are the different formulas? Yield on investment means what is the yield divided by investment into 100, and percentage of profit on sales is total profit, that is gross profit divided by sales into 100, and rate of cash generation per annum before tax. All these three we should find out. Uh, Apart from working capital management, you like working capital requirement, you should also find working capital requirement and these three uh, ratios. So details of the proposed project for expected production of 250 metric ton are as under. First, investment. What are the different investment? Land, building and plant and machinery. And cost of production per annum. What is the cost of product? Imported raw material 6 lakh 50, indigenous raw material 6 lakh 26, salaries and wages 1 lakh 35,000. So repairs and maintenance on plant cost, that is 5% on plant cost you should find out, and repairs and maintenance on building, so 2% on building. Depreciation, administrative and other expenses, which is 50,000. See here, administrative and other expenses they have mentioned. So we can take it in two ways. That is, one is we can assume it as fully relatable to cost of production. Then we should assume that the other expenses also form part of administrative expenses. So administrative and other expenses, either you can take it as only administrative expenses, then you can add it to cost of production. Or if you are thinking that, like if you are assuming other expenses include selling and distribution expenses, then those administrative and other expenses should not be included in the cost of production. Why we won't include selling and distribution expenses in cost of production? Because selling and distribution expenses occurs only when the finished product is ready and finished good is ready and it is available for sale. So at that point of time only you will be expending this selling and distribution expenses. So if you are assuming that this other expenses include selling and distribution expenses, then you should not add it in the cost of production. This 50,000 should be excluded from the cost of production. So next is steam requirement 7,000 metric ton at 16 per metric ton. This steam requirement is also form part of cost of production. Then power 6,000 rupees. Packing drums of 500 kg capacity 30 rupees each. For each 500 kg capacity 30 rupees each. So, and point number 3, working capital requirement. Like what are the different time period for the current assets and liabilities? Imported raw material stock should be maintained for 6 months. That is 6 months of stock should be readily available in the closing stock. Next, indigenous raw material and packing material stock 3 months. Stock of finished products 1 month. Credit to customers given, like debtors is 1 month and creditors is also 1 month. And creditors for suppliers is 1 month, but only on indigenous material and packing material. So this imported raw material, there is no credit facility. Then cash expenses is 1 month. So this is working capital requirement. So with this we have completed the question. So what they are asking us to find is, see, uh, apart from working capital requirement. How will you find working capital requirement? We have got all the data here. What is the time period? So with this we can find what is current assets and what is current liabilities, and we can easily find out net working capital requirement. So then for percentage of yield on investment, what is the total investment? Summation of this investment is the total investment. What is this percentage on yield? That percentage on yield is how much is the total sales value, that is 250 into 8500, 250 metric ton of quantity into 8500 per metric ton. So that is the sales value. And what is the total cost? All this cost of production we should summarize it, and we should find the profit. So that is the profit on, like, yield on investment. And profit divided by sales is what is the profit and the divided by sales. And rate of cash generation per annum before taxes, this depreciation we should add back to the profit what we have derived. So we'll get the total cash generation per annum, that is before tax. Okay, now we'll take down the problem. We'll go to solution. Problem number 6. Take the notes. Problem number 6. Underline it. Problem number 6. Statement number 1. Statement showing calculation of profit per annum. Statement showing calculation of profit per annum. Statement showing calculation of profit per annum. Divided into 3 column table. First column particulars. First column particulars. Second column amount. Third column also amount. Particulars, amount and amount. Below that particulars, small a. Below the particulars, small a, sales value. What we are finding in the first statement, we are finding the profit per annum. So total sales value minus total cost, we will get the profit per annum. So sales value, small a, sales value, within bracket put 250 into 8500. 250 is the total quantity and 8500 is selling price per quantity. So 250 into 8500. 250 into 8500. So in the outer amount column put 21,25,000. Outer amount column put 21,25,000. Below that, small b. Small b, total cost. Small b, total cost. What are the different costs incurred for producing the product? This chemical X. See point number row number 2, cost of production. All these are different costs which have been incurred. So take down one by one. First, imported raw material. Below the total cost, imported raw material. Imported raw material. Inner amount column 6,50,000. Inner amount column 6,50,000. Next, indigenous raw material. Indigenous raw material 6,26,000. 6,26,000. Next, salaries and wages. Salaries and wages 1,35,000. 1,35,000. Next, repairs and maintenance of plant. Repairs and maintenance below that plant. Repairs and maintenance below that plant. Within bracket, how much is the plant and machinery value? 12 lakhs into what is the percentage of repairs and maintenance on plant cost? 5%. So within bracket, 12 lakhs into 5%. 12 lakhs into 5%. Inner amount column 60,000. Inner amount column 60,000. Below that, building. What is the repairs and maintenance cost of building? 2%. So next to building, open a bracket. What is the building cost? 8 lakhs. So 8 lakhs into 2%. Within bracket, 8 lakhs into 2%. Inner amount column 16,000. Inner amount column 16,000. Below that depreciation. So depreciation is also on plant and building. So depreciation, below that arrow mark, first arrow mark, plant. Below that first armor plant. What is the plant value? 12 lakhs. So depreciation is 7%. So within bracket 12 lakhs into 7%. Plant within bracket 12 lakhs into 7%. Inner amount column put 84,000. 12 lakhs into 7% is 84,000. So below that building. What is the depreciation on building cost? 2.5%. That is 2.5%. So what is the building cost? 8 lakhs. So next to that building, open a bracket, 8 lakhs into 2.5% and close the bracket. 8 lakhs into 2.5%. So inner amount column 20,000. Inner amount column 20,000. Now depreciation also over. Below that, what is they have given? Administrative and other expenses 50,000. So while calculating profit, all the expenses including selling and distribution expenses, all the expenses should be added in order to find the profit per unit. So profit per annum. So add administrative expenses. Administrative expenses 50,000. 50,000. Next steam. Next is steam. Within bracket, how much is the steam requirement? 7,000 metric ton at 16 per metric ton. So open a bracket, 7,000 into 16. 7,000 into 16. Inner amount column 1,12,000. Inner amount column 1,12,000. Next is power. Power. How much they have given? 6,000. So power inner amount column 6,000. Power inner amount column 6,000. Next, the last one is packing drums. Packing drums. Below that, open a bracket. See what they have given. Packing drums of 500 kg capacity is 30 each. So how much kg we are producing? So here we are producing 250 metric ton. One ton is equal to 1000 kgs. So we are producing 250 metric ton into 1000. So we are producing 2,50,000 kgs. Okay, we are producing 2,50,000 kgs. But for every 500 kg, 30 rupees each. So 2,50,000 kgs divided by 500 into 30. So that will be the packing drums cost. So below that, below packing drums, open a bracket. 250 metric tons. That is 250 into 1000. 250 into 1000 divided by 500. Divided by 500 into 30. Into 30. That is for every 500, 30 rupees each. So close the bracket. 250 into 1000 divided by 500 into 30. So inner amount column 15,000. Inner amount column 15,000. Now total the inner amount column. What is the total cost? Now total the inner amount column. Underline it. Outer amount column put 17,79,000. Just total the total cost. 6,50,000 plus 6,26,000 plus 1,35,000 plus 60,000 plus 16,000 plus 84,000 plus 20,000 plus 50,000 plus 1,12,000 plus 6,000 plus 15,000. So total is 17,74,000. Just cross check it once. Seventeen lakh 74,000. Outer amount column 17,74,000 within bracket. Put 17,74,000 within bracket. So now below that total it 21,25,000. 21,25,000 minus 17,74,000. Minus 17,74,000. Now total it 3,51,000. 3,51,000. In respect of the 3,51,000, profit per annum. Profit per annum. So we have found out what is the profit. So we have completed what is profit per annum. So now statement number 2. Below that, statement number 2, calculation of working capital requirement. Calculation of working capital requirement. Calculation of working capital requirement. Below that, 3-column table, particulars, calculation and amount. First column particulars, second column calculation, and third column amount. Particulars, calculation and amount. So what is the format? First, current assets. So below the particulars, capital A, current assets. Below particulars, capital A, current assets. What are the different closing stocks? Here there are 2 stocks, whereas there are actually 3 stocks, that is imported raw material, indigenous raw material, packing material. For imported raw material stock, they have given 6 months. Indigenous raw material and packing material, they have given 3 months time period of closing stock. So first, stock of imported raw material. Below that, current assets, put first stock of imported raw material. Stock of imported raw material. Calculation column. What is the total imported raw material? 6,50,000. 6,50,000 into 6 divided by 12. Into 6 divided. That is 6 months of stock should be lying in the closing stock. So 6,50,000 into 6 by 12. Amount column, put 3,25,000. 6,50,000 into 6 by 12. Amount column, 3,25,000. Next, stock of raw material. That is stock of indigenous raw material. Stock of indigenous raw material. Stock of indigenous raw material. What is the time period they have given? 3 months. So in calculation column, 6,26,000 into 3 by 12. 6,26,000 into 3 by 12. Amount column, 1,56,500. 1,56,500. So below that, stock of packing drums. Stock of packing drums. So what is the total value of packing drums which we are spending? Total stock value of packing drums per annum is 15,000, which we found by multiplying 250 into 1000 divided by 500 into 30. That is 15,000. So 3 months of stock should be maintained in the closing stock. So 15,000 into 3 divided by 12. 15,000 into 3 divided by 12. Amount column, 3,750. Amount column, 3,750. So next, credit to customers. Credit to customers, they have given 1 month. See, you should understand this one point. Whenever they have given some quantity of sales as credit sales, that is 10% of sales cash sales or 90% of sales is credit sales, if they have not mentioned anything, you can assume whatever you want as a percentage, but you should give an assumption. Suppose in this particular problem, they didn't tell how much is the cash sales and how much is the credit sales. So what we are assuming is, we are assuming entire sales as credit sales. That is the total sales value. That is 21,25,000. 250 into 8,500 is 21,25,000. So entire sales value as credit sales. So if you want to assume 50% credit sales and 50% cash sales, you can assume it, but you should give an assumption. So here we are assuming 100% of sales as credit sales. So debtors, below that stock of packing drums, debtors. Calculation column, 21,25,000 into 1 by 12. Why we are assuming 21,25,000 is, we are assuming all entire sales as credit sales. So 21,25,000 into 1 by 12 into 1 by 12. Amount column 1,77,083. 1,77,083. So data says 1,77,083. Next is stock of finished goods. Next is stock of finished goods. So how much is the stock of finished goods we should find? So for finding the stock of finished goods, what is the basic requirement? Cost of production. Till the good is made available as a finished goods, what are all the expenses incurred? Then that is called as cost of production. Once the production is done, the goods are to be claimed as unfinished good. And if the goods are being sold, that time what all expenses are incurring, we are incurring, that expenses are called as selling and distribution expenses. So till the goods attain the finished goods status, whatever the expenses has been incurred for producing such goods, that is called cost of production. So here for calculating the closing stock of finished goods, we need what is cost of production. How to find this cost of production? So the total cost is, see, the total cost is 17,74,000. Total cost is 17,74,000. On that, what are all the expenses which do not form part of cost of production? See, packing drums. Packing drums are required only when goods are being sold. That is, when we will pack the goods, when it is going to get sold, or when the goods are attained the finished status, then only we will be packing that goods for selling it. So this 15,000 is included in the cost of selling expenses, cost of like selling and distribution expenses. So next to stock of finished goods, open a bracket. One second. 17,74,000 Okay, come. What is the cost of production is? See, I'll simply explain you a small concept. See, you would have studied in cost accounting in the paper number paper number 4. Like, what is the total expenses incurred till cost goods are ready for sale? That is, till goods are attaining the finished goods. Then it is called cost of production. That is all the prime cost, direct material, direct labor, and direct expenses. Add a factory overheads, we'll get factory cost. Add administration expenses, then we'll get cost of production. So this cost of production, this should be taken as a value for finished goods. So what are all the different expenses here which should be included in the cost of production? Imported raw material we should include, indigenous raw material we should include, salaries, both raw material, direct material, salaries and wages, direct labor, repairs and maintenance. Repairs and maintenance of what? That matters. So here repairs and maintenance of plant which is used in the factory, building which is used in the factory, used as a factory. So we are assuming this repairs and maintenance is entirely for factory purposes. So it will be included in the cost of production. So 60,000 and 16,000 should be included. Always we won't include depreciation in the cost of production. So this depreciation 84,000 and 20,000 should be removed from the total cost. And next, administration and other expenses. Here, if we are considering this as only administration expenses, as I explained when we were discussing about the question, that time itself I told, if you are assuming this administration and other expenses as only administration expenses, then it form part of cost of production. Whereas if you are assuming this other expenses, administration and other expenses as selling and distribution expenses being included, then this 50,000 should not be included in the cost of production. So now in this sum we are assuming this other expenses includes selling and distribution expenses. So this 50,000 should be excluded. So steam form part of production, so it should be included. Power also form part of production. And packing drums, see, we can classify it as two types. In my when I was giving actually this question has been asked in my exam, I think so. Packing drums, I assumed it as it form part of selling and distribution expenses because these packing drums are used only when goods are being packed for sale. So we can assume it as distribution expenses. But In this problem, that in this particular problem, it has been assumed as direct material, and it will be included in the cost of production. So what are all the different costs which you should exclude? Depreciation cost, plant and building, and administration and other expenses cost. All these three should be excluded. So 17,74,000 is the total cost, minus 84,000, minus 20,000, minus 50,000. If we remove these three, the total cost of production is 16,20,000. On that, what is the time period? Stock of finished goods is 1 month. So into 1 divided by 12. So amount column 1,35,000. So in respect of that stock of finished goods, in calculation column, record it 17 lakh, with open a bracket, 17,74,000, 17,74,000 minus 50,000 minus 84,000 minus 20,000. Close the bracket, into 1 by 2, 1 by 12, into 1 by 12. Amount column 1,35,000. Amount column 1,35,000. So stock of finished goods should be always valued at cost of production. That is point number 1. And point number 2, what all should be included in the cost of finished goods? That is cost of production should be assumed by the exam, like a student on himself. You can assume it on yourself. Like if you want to include packing drums, you can include it, or if you want to exclude it, you can exclude it. But for everything, you should give assumption. You should write like this is the assumption behind the assuming whether this administrative, selling and distribution expenses for not being included in the cost of production. This should be explained in the assumption part. So here in this, see, they have excluded, they have written an assumption, but you should not write here and all. You should write in the separate down, like you should give some space for this working notes and assumptions. So why depreciation has not been included? Depreciation has not been included because non-cash expenses not to be included in included. Since selling and distribution overheads is not mentioned, administrative overheads and other expenses is considered as selling and distribution overheads. This is also an assumption. What they are giving second assumption is, since selling and distribution overhead is not mentioned in the problem, administrative overhead and other expenses is considered as selling and distribution overheads. So that is the reason behind not assuming the administration and other expenses in the cost of production. So with this, we have completed current assets. So now totally current assets, 3,25,000 plus 1,56,500 plus 3,750 plus 1,77,083 plus 1,35,000. So the total, in respect of total, put 7,97,333. 7,97,333. So below that, capital B, current liabilities. Below that, capital B, current liabilities. Under capital B, current liabilities, record creditors for indigenous raw material. See here, there are three materials, that is imported raw material, indigenous raw material, packing drums, three materials. But the credit from suppliers are available only on indigenous raw material and packing material. So imported raw material, there is no credit supplies. So creditors for indigenous raw material. Creditors for indigenous raw material. What is the indigenous raw material value? 6,26,000. What is the time period given? 1 month. So 6,26,000 divided by 12 into 1 by 12. That is, in respect of amount column, put 52,167. 52,167. Below that, creditors for packing material. Creditors for packing material. For packing material also, it is 1 month. So what is the packing material value which we found? Packing drums, 15,000. So in respect of calculation column, 15,000 into 1 divided by 12. 15,000 into 1 divided by 12. In respect of amount column, 1,250. 1,250. Next, outstanding cash expenses. That is, here, see, this cash expenses entry we have not seen in any problem. They have just told cash expenses 1 month. You can assume it in 2 ways. This also you can assume it in 2 ways. Either you can assume it, this cash expenses are paid in advance 1 month. Then you should include it in current assets. If you are paying something in advance, then you should include in current assets. and if you are paying something in arrears, you should include in current liabilities. Here they have only mentioned cash expenses 1 month. They didn't tell whether it is paid in arrears or it is paid in advance. So whenever they are not mentioning whether arrears or advance for such cash expenses or any other outstanding expenses, then you should assume it for as arrears. You should not assume it as advance. If you assume it as arrears, you should take it to the current liabilities. So here they have mentioned cash expenses and we are assuming it as arrears. So in respect of cash expenses, 1 month, they have mentioned 1 month. So cash expenses is 1 month. Below that, creditors for packing material, record outstanding cash expenses. Outstanding cash expenses within bracket. What are all the different cash expenses? See, whatever they have given time for credit, excluding that remaining are cash expenses. Simple. Whatever they have given on credit, they have given credit for only material. They have not given any credit for this expenses. So this cash expenses, every expenses which have been excluded as cash, then it should be included in this cash expenses, and 1 month of arrear time period should be given to that cash expenses. So here repairs and maintenance of plants cost, salaries and wages. First is salaries and wages, 1,35,000. 1,35,000. And repairs and maintenance of plant cost, 5% of 12 lakhs, that is 60,000. So below that outstanding cash expenses, open a bracket, 1,35,000 plus repairs and maintenance on plant cost 60,000 plus repairs and maintenance on building, that is 16,000 plus administrative and other expenses 50,000 plus steam requirement 1,12,000 plus power 6,000. So all these are different cash expenses. Close the bracket. Into 1/12. Into 1/12. Into 1/12. Amount column put 31,583. Sorry, 31,583. So with this we have completed current liabilities. Now total it. 52,167 plus 1,250 plus 31,583. So total is 85,000. So below that total it 85,000. In respect of that 85,000, put total. In respect of that 85,000, put total. Below that C. Below that capital C. Net working capital. Net working capital. Open the bracket. Capital A minus capital B. Capital A minus capital B. Now what is the current assets? 7,97,333 minus 85,000. So in respect of that net working capital, amount column put 7,12,333. 7,12,333. So with this we have completed what is net working capital requirement. Simple. Those assumptions are the important points in this problem. Whenever they are not giving any criteria, you should assume it. Suppose cash expenses they have given, they didn't mention whether arrears or advance, then you should consider it as arrears. Then second one, they have not mentioned administration or other expenses as selling and distribution overheads, but you are considering it as selling and distribution overheads. So you are assuming it. So you should give an assumption below in the notes. And depreciation costs are non-cash expenses, so you are not including in the cost of production. That also you should mention it as assumption. So these are the different assumptions you should mention. So with this we have completed net working capital. So what are all the three formulas which they have asked? Percentage of yield on investment, percentage of profit on sales, and rate of cash generation per annum before tax. So for calculating this percentages, you need total investment value, what is the yield value, what is the sales value, what is the profit, and what is the cash generation, total cash generated. So first put statement number 3. Statement number 3. For percentage of yield on investment, we need total investment. For percentage on yield on investment, we need total investment which has been invested in the business. So statement number 3, calculation of total capital required. Calculation of total capital required or investment required. We can mention anything. Calculation of total investment required. Below the two column table, first column particulars, second column amount. First column particulars and second column amount. Below that particulars, land. Land amount column 1 lakh. Amount column 1 lakh. Next, building. Amount column 8 lakh. They have given 8 lakh. Building 8 lakh. Next is plant and machinery. Plant and machinery. Amount column 12 lakh. Amount column 12 lakh. Next, see this net working capital is also an investment. That is investment in working capital. You need that 7,12,333 to run the business. So this 7,12,333 is also an investment, but it is a net working capital, because see, net working capital is nothing but current assets minus current liabilities. So this is form part of working capital requirement. So whenever you're forming a capital statement, you will always include what is net working capital, what is the working capital required. So it also form part of total capital. So below the plant and machinery, investment in working capital. Investment in working capital. Within bracket statement number 2. Within bracket statement number 2, what is the amount? 7,12,333. 7,12,333. Now total it. 28,12,333. 28,12,333 in respect of that total investment. In respect of that total investment. So with this we have calculated what is the total investment to. So three formulas they are asking: profit on investment, profit on sales, and cash profit divided by total investment, that is rate of cash generation. So first statement number 4, below that statement number 4, statement Roman number 4, that is statement number 4, calculation of ratios, calculation of required ratios, calculation of required ratios. Below that, small Roman number 1, percentage of yield on investment, small Roman number 1, percentage of yield on investment, yield, YIELD, yield on investment. So below that write the formula. What is the yield on investment? Yield, normally yield on investment is nothing but what is the return on investment. So yield is profit divided by investment into 100. So what is the profit which we have write the formula? Profit divided by investment into 100 is equal to profit divided by investment into 100. In statement number 1, we have found that profit is 3,51,000. 3,51,000. So below that, calculate 3,51,000 divided by 28,12,333. That is the investment which we found in working note number, statement number 3. 28,12,333. So 3,51,000 divided by 28,12,333 into 100. Into 100 is equal to 12.48%. 12.48%. So below that, small Roman number 2. Small Roman number 2, percentage on profit on sales. Percentage on profit on sales is equal to profit divided by sales into 100. Is equal to profit divided by sales into 100. So profit is 3,51,000 divided by 21,25,000 into 100. 3,51,000 divided by 21,25,000 into 100. Sales which we found using multiplying the total quantity into rate per unit, per metric ton. So 3,51,000 divided by 21,25,000 into 100 is equal to 16.52%. Calculate it. Don't just note it down. You just calculate it using the calculator. 3,51,000 divided by 21,25,000 into 100 is equal to 16.52%. And what is the last formula which they ask? Rate of cash generation per annum before tax. So in this particular profit which we have earned and cost which we have incurred. Only depreciation is the non-cash item. Remaining all cash expenses. So for calculating the cash profit, what we should do? Normal profit plus non-cash expenses. Can you understand? What is the profit plus non-cash expenses? If we add, then it is cash profit. So put Roman number 3, small Roman number 3, rate of cash profit. Small Roman number 3, rate of cash profit. Write the formula: profit plus depreciation. Profit plus depreciation divided by investment into 100. Divided by investment into 100. Profit plus depreciation divided by investment into 100. Below that, take down the numbers. 3,51,000 is the profit. So 3,51,000 plus what is the total depreciation? Just add depreciation on plant and depreciation on building. You will get 1,04,000. 3,51,000 plus 1,04,000 divided by 28 lakhs 12,333. That is investment value, which we found in statement number 3. So 3,51,000 plus 1,04,000 divided by 28 lakh 12,333. 28 lakh 12,333 into 100. Into 100 is equal to, calculate the answer, is equal to 16.18%. 16.18%. So below this is the problem. Actually, what they have asked is, they have asked us, actually they didn't ask us to calculate net working capital only, but because they have given working capital requirement, we have calculated net working capital. But in the question, they have not asked us to calculate net working capital. So we found net working capital, and they asked us to find 3 formulas. That is, what is yield on investment, profit on sales, and cash generation. So all these 3 formulas we have found. So always remember, whatever you are assuming in the problem, you should give it as note. If you are not giving it as note, they'll think you have did something wrong. So you should always give it as notes. So below the full entire problem, below the working notes, you should always note the assumptions. So you just take down the assumptions which we made in this particular problem. Below that statement number 4, take down notes. Notes, assumption. Notes, assumption. First remark, it is assumed that administrative overheads relatable to, it is assumed that admin overheads relatable to selling and distribution. Selling and distribution. Full stop. Accordingly, not considered as a part of cost of production. Accordingly, not considered as part of cost of production. So what we are doing, we are assuming that this administration and other overheads and other expenses, we are assuming it includes selling and distribution overheads. So we are not taking it as part of cost of production. So second, below that second arrow mark, it is assumed that cash expenses will be paid in 1 month arrears. We assume no, this cash expenses 1 month arrear. We can assume it as advance also, but we assumed it as arrears, so we are giving notes. It is assumed that cash expenses will be paid in 1 month arrear. So with this, we have completed the problem number 6. So last problem of this particular unit, that is problem number 8. This problem might look very big, but very easiest problem. Very easy problem. So Camlia Industries Limited, problem number 8. Camlia Industries Limited is desirous of assessing its working capital requirements. So this C Limited is wishing to calculate the working capital requirements for the next year. The finance manager has collected the following information for the purpose. It has collected the following information. What they have collected: estimated cost per unit of finished product. What are the different costs which are incurring to produce a product? Raw material 90, direct material 50 rupees, manufacturing administrative overhead excluding depreciation, there is no depreciation, 40, and depreciation is separately given 20, selling overheads 30. So total cost of producing a unit is 230 rupees, and the product is subject to excise duty of 10% levied on cost of production and is sold at 300 per unit. So the total the selling price per unit of the product is 300 rupees and total cost is 230 rupees. Apart from that, excise duty of 10%. Additional information. Point number 1, budgeted level of activity is 1,20,000 units of output for the next year. That is, see, budgeted level of activity, which means total number of units which are going to be sold is 1,20,000 units. And point number 2, raw material cost consists of following. See, they have given a breakup for raw material. Here in this particular table, they have given 90 rupees. Whereas here in this point number 2, they have given a breakup for this raw material cost, which is pig iron 65 per unit, ferro alloys 15 per unit, cast iron borings which is 10 per unit. So if you summate that, 65 plus 15 plus 10, which is 90 rupees. So pig iron 65, ferro alloys 15, and cast iron borings, that is 10 rupees per unit. This is the raw material breakup. And point number 3 is raw materials are purchased from different suppliers extending different credit periods. Super. See, for each supplies, that is each raw material, that is pig iron, ferro alloys, and cast borings, there are different periods, that is different credit periods. So you should calculate closing stock for each product in a you should calculate creditors for each product separately. Creditors for pig iron, creditors for ferro alloys, creditors for cast iron borings. So that is how you should calculate the creditors for purchases. And next is point number 4. Point number 4 is product is in process for a period of half month. That is, work in progress is half month. Okay. Product process requires full unit 100% of pig iron. See, what is the combination of the work in progress that they have explained. In a work in progress, 100% of pig iron and ferro alloys in the beginning of production, and cast iron borings is required only to the extent of 50% in the beginning, and remaining is needed at the uniform rate. That is 50% at the beginning, and out of remaining 50% at the regular interval. That is like suppose the cast iron borings is 10 rupee per unit. First 5 rupees should be included in the beginning. Out of remaining 5 rupees, it should be in the uniform way. That is remaining 5 rupees into 50%. So, and remaining is needed at the uniform rate during the process. Direct labor and other overheads accrue at similar rate similarly at a uniform rate throughout the production process, which makes 50%. So they have given what is the breakup and what is the percentage of completion for this work in progress. So next is point number 5. Past trends indicate that pig iron is required to be stored for 2 months. That is, closing stock of raw materials. Each raw material has been mentioned separately. That is, for pig iron, that is 2 months, and for other materials, that is ferro alloys and cast iron borings, it is 1 month. Easy. So next, point number 6. Finished goods are in stock for a period of 1 month. Work in progress also 1 month. Finished work in progress is half month. Finished goods is 1 month. Pig iron is 2 months. Ferro alloys and cast iron boring is 1 month. These are the different stocks, different closing stocks, and different time period. And point number 7. It is estimated that 1/4 of total sales are on cash basis. So remaining 3/4 is on credit. And past experience of the firm has been collected that credit sales in 2 months. That is, debtors is allowed for 2 months. So point number 8. Average time lag in payment of all overheads is 1 month and half a month in case of direct labor. Simple. For overheads it is 1 month, and for direct labor it is half month. Desired cash balance to be maintained is 10 lakhs. So you are required to determine the amount of net working capital of the firm. State the assumptions if any. So if I leave you, you should do this problem on yourself, because this is summarization of all the remaining problems. Is the problem number 8. The 8th problem is like it includes all the adjustments, but we'll finish it. we itself will do it. So problem number 8. Now you would have got an idea about the question. Now we'll take down the answer. You will understand the concept of segregating the raw materials into 3. So take down problem number 8. Problem number 8. Statement number 1. Statement number 1. Calculation of requirement of working capital. Calculation of requirement of working capital. Below that 3 columnar table. Below that 3 columnar table. First column particulars. Second column calculation. Third column amount. Particulars, calculation and amount. Below that particulars, capital A. Below that particulars, capital A, current assets. Capital A, current assets. In that current assets, see, they have segregated stocks into work in progress, pig iron, ferroalloys, cast borings, then finished goods. So these are the 5 types of closing stock which we should calculate. So first we will calculate cost of work in progress. Stock of work in progress. Stock of work in progress. For calculating stock of work in progress, first we need to calculate what is work in progress per unit. So leave 1 page gap. Leave 1 page gap. In the next page, put working notes. Working notes. Note number 1. Note number 1. Put that in calculation of value of work in progress per unit. Calculation of value of work in progress per unit. Value of work in progress per unit. Below that 3 columnar table. Below the 3 columnar table, first column particulars. First column particulars. Second column amount and third column also amount. Particulars, amount and amount. Below that particulars, small a. Here there are 2 types, that is materials being introduced at different period, and whereas the cost of that material is also differing. So capital A, materials introduced at the beginning of the process. Materials introduced at the beginning of the process. So in the beginning, see point number 4 for work in progress, they have mentioned in point number 4, that is for work in progress it is half month. So keep it aside. For work in progress stock, it should be readily available for half month. That is point number 1. And point number 2 is production process is requiring full unit of pig iron and ferroalloys in the beginning. So what are all the different products, raw materials required at the beginning? Pig iron and ferroalloy 100%. So below that put pig iron. Pig iron within bracket 65, because raw material pig iron cost is 65 per unit. So 65 into, they have given 100% required at the beginning. So into 100%. So close the bracket. Pig iron within bracket 65 into 100%. Inner amount column 65. Inner amount column 65. Below that ferroalloys. Ferroalloys is also required at the beginning of the production 100%. So ferroalloys within bracket, what is the per unit cost? 15. So within bracket 15 into 100%. 15 into 100%, close the bracket. So amount, inner amount column, put 15 rupees. 15. So below that cast iron boring. See, understand cast iron boring thing, it is complicated little. What they are explaining is cast iron borings is required only to the extent of 50% in the beginning. That is, out of 100% of cast iron borings material, 50% is required in the beginning, and remaining 50% is required from the beginning till the end at the uniform rate. So simple. Suppose 10 rupees, the given amount is 10 rupees cast iron borings for 1 unit. Out of that, suppose this is 1 unit, 10 units. Out of that, 5 units you should give in the beginning itself. So suppose 5 units if you are giving in the beginning, remaining 5 units you are going to give the entire year in regular intervals. So that 5 units which we are giving in the beginning, that should be included in the material introduced at the beginning of the process. So below that ferroalloys, cast iron borings, cast iron borings, within bracket 10 rupees per unit cost is 10 rupees. 10 into 50% is required at the beginning. 50% is required at the beginning itself into 100%, because beginning we will calculate 100%. Whenever we are introducing any materials in the beginning, entire 100% is completely given in the beginning itself. So 10 into 50% into 100%. So inner amount column 5 rupees. Inner amount column 5 rupees. Now total it. Put in outer amount column, underline it and put in outer amount column 85 rupees. 85 rupees. Next, below that small b, cost incurred uniformly. Small b, cost incurred uniformly. Uniformly in sense nothing but 50%. Whenever they are giving uniformly, you should assume it as 50% being given to the production process and remaining 50% is yet to be given. So cost incurred uniformly. Below that, cast iron borings. Cast iron borings. See, understand it properly. 10 rupees cast iron borings required. Total raw material of cast iron borings required is 10 rupees. In that 5 rupees you have already given in the beginning itself. So what is remaining available? 5 rupees. Remaining 5 rupees, you should give it in the regular interval. What they are telling is remaining is given at the uniform rate. So this 5 rupees is given at uniform rate. So this 5 into 50%. So next to that cast iron borings, open a bracket, 5 into 50%. 5 into 50%. Inner amount column 25 rupees. See, 2.5 rupees. Sorry. 5 into 50%. Inner amount column 2.5 rupees. 2.5 rupees. Below that, direct labor. How much is the direct labor? They have given 50 rupees. So next to the direct labor, open a bracket, 50 rupees into 50%. 50 into 50% and close the bracket. How much is the 50 into 50%? That is 25 rupees. Inner amount column 25 rupees. Inner amount column 25 rupees. Below that, manufacturing and administrative overhead. See, in work in progress, you should consider this manufacturing and administrative overhead. Same like cost of production, where you are not considering selling and distribution overhead. While calculating work in progress also, you should not consider selling and distribution overhead. You should always calculate only manufacturing and administrative overhead. Here, manufacturing and administrative overhead excluding depreciation is given, because in work in progress, depreciation should not be included. So manufacturing and administrative overhead, below the direct labor, manufacturing and administrative overhead, within bracket, how much is the amount? 40. So 40 into 50%. 40 into 50%. Amount column 20. Inner amount column 20. Now total it, 2.5 plus 25 plus 20. 2.5 plus 25 plus 20. Outer amount column put 47.5. 47.5. So now total the outer amount column. 85 plus 47.5. 85 plus 47.5. Total 132.5. 132.5. In respect of that 132.5, put work in progress per unit. 132.5. In respect of that 132.5, work in progress per unit. So with this we have calculated what is work in progress per unit. So we can calculate what is the stock of work in progress now. So see, below that current assets, you recorded stock of work in progress. No. In respect of that calculation column, in respect of the stock of work in progress, in calculation column, what is the total number of units? Budgeted level of activity is 1,20,000 units of output for next year. It is for whole year, not for a month, it is for whole year. So total units is 1,20,000 into what is the cost per unit, that is work in progress per unit, which we calculated now, 132.5 into what is the time period they are giving for work in progress, 0.5 month, that is half a month, into 0.5 divided by 12. So calculation column recorded 1,20,000 into 132.5. 1,20,000 into 132.5 into 0.5 by 12 into 0.5 divided by 12. So amount column 6,62,500. 6,62,500. 6,62,500. So below that, stock of pig iron. Stock of pig iron. So for stock of pig iron, what is the time period they have given? For pig iron, it is 2 months, and for other material, it is 1 month. So for pig iron, it is 2 months. In the calculation column, record it 1,20,000. That is total number of units. 1,20,000. What is the pig iron cost? 65 per unit. So 1,20,000 into 65 into 2 divided by 12. Into 2 divided by 12. So amount column 13 lakhs. In respect of that, amount column 13 lakhs. 13 lakhs. So below that, stock of ferroalloy. Stock of ferroalloy. What is the time period they have given? For other material, it is 1 month. So this ferroalloy costs 15 rupees per unit. So in respect of stock of ferroalloy, in calculation column, record it 1,20,000. 1,20,000 into 15 into 1 divided by 12. 1,20,000 into 15 into 1 divided by 12. Amount column recorded 1,50,000. 1,50,000. Below that, stock of cast iron borings. Below that, stock of cast iron borings. Calculation column recorded 1,20,000. 1,20,000. What is the cost per unit? 10. 1,20,000 into 10 into 1 divided by 12. 1,20,000 into 10 into 1 divided by 12. Amount column 1 lakh. Amount column 1 lakh. Below the stock of finished goods. Stock of finished goods. So to calculate stock of finished goods, we need what is the cost of production. Here they have given raw material total cost is 90 rupees per unit plus direct labor is 50 rupees per unit plus manufacturing is 40 rupees per unit. So all these three are includable in the cost of production, whereas depreciation and selling overhead are not includable in the cost of production. As simple as that. Always in cost of production and work in progress, only till administrative overhead you should include. That too, depreciation you should exclude of. Okay, stock of finished goods. In respect of calculation column recorded 1,20,000 units, 1,20,000 into what is the total cost of production? Raw material plus direct labor plus manufacturing overhead is 180. So 1,20,000 into 180 into what is the finished goods time period? Here they have given finished goods are in stock for a period of 1 month. So into 1 by 12. 1,20,000 into 180 into 1 divided by 12. So amount column recorded 18 lakhs. 18 lakhs. 18 lakhs. Below that, debtors. Below that, debtors. See, debtors what they have given, 3/4 are credit sales and 2 months time period. 3/4 is credit sales and 2 months time period. So what is the sales value? Selling price 300. So in respect of the debtors recorded 1,20,000. 1,20,000 into 300 rupees per unit into 1,20,000 into 300 into 3 divided by 4 into 2 months time period. So 2 divided by 12. 1,20,000 into 300 into 3 by 4 into 2 by 12. So amount column recorded 45 lakhs. Amount column recorded 45 lakhs. And below that, last one, cash and bank balance. Cash and bank balance. Cash and bank balance, they have clearly mentioned it is desired cash balance is 10 lakhs. So in respect of that cash and bank balance, in amount column 10 lakhs. Now total the current assets. Now total the current assets. Total the current assets. Amount is 95 lakh 12,500. 95 lakh 12,500. In respect of that, total A. In respect of that, total within bracket A. So below that, put capital B. leave one line gap and put capital B. Current liabilities. Capital B, current liabilities. Below that current liabilities, first creditors for purchase. Creditors for purchase. As I told in the beginning, creditors for purchase should be segregated into three because for all three are different suppliers. So all three products requires different credit payments. So pig iron is 2 months, ferroalloys is half month, cast iron borings is 1 month. So based on that, you should calculate the creditors for purchase. So below that creditors for purchase, put arrow mark 1. Put the first arrow mark pig iron. Pig iron. In respect of amount column, put 1,20,000. That is total number of units. 1,20,000 into pig iron cost is 65. 1,20,000 into 65 into 2 divided by 12. 1,20,000 into 65 into 2 divided by 12. Amount column 13 lakhs. Amount column 13 lakhs. Below that second arrow mark ferroalloys. Second arrow mark ferroalloys. Calculation column 1,20,000. 1,20,000 into 15 into 0.5 divided by 12. Into 0.5 divided by 12. Amount column 75,000. Amount column 75,000. Below that third arrow mark cast iron borings. Cast iron borings. Calculation column 1,20,000. 1,20,000 units into 10 rupees per unit. Cast iron borings is 10 rupees per unit. 1,20,000 into 10 rupees per unit into what is the time period given for raw material? It is for raw material for purchasing it from different suppliers, it is 1 month, and for maintaining the stock also it is 1 month. So see, you should not always confuse this raw material suppliers time with the stock maintenance time. Stock maintenance time should be taken to the current assets, and raw material credit period given should be taken to the current liabilities. Don't confuse both with different numbers. So these both are different. Like whatever the stock is there, for that stock, whatever they are mentioning to as closing stock, you should take it to the current assets, and whatever the time period which they are mentioning for suppliers credit should be taken to the current liabilities. So in this cash and borrowings 1,20,000 into 10 into 1 by 12. So amount column 1 lakh. Amount column 1 lakh. So below that next outstanding overheads. Outstanding overheads. Here they are given for outstanding overheads time period of 1 month. So what are all the different overheads to be paid? Manufacturing administrative overhead is 40. Manufacturing administrative overhead is 40. So outstanding administrative overhead. Outstanding manufacturing and administrative overhead. Record it as admin overhead. Outstanding admin overhead. Calculation column 1,20,000 into 40. They have given 40 rupees. So 1,20,000 into 40 rupees into time period is 1 divided by 12. Time period is 1 divided by 12. Amount column 4 lakhs. Amount column 4 lakhs. Below that outstanding wages. For outstanding wages they have given time period of 0.5 month. That is half a month. So outstanding wages in respect of that calculation column 1,20,000 units into 50 rupees per unit. Wages cost is 50 rupees per unit into 0.5 by 12. 1,20,000 into 50 into 0.5 by 12. Amount column 2,50,000. Amount column 2,50,000. Below that outstanding selling overheads. Below that outstanding selling overheads. Outstanding selling overheads. Here they are given selling overheads is 30 rupees. So 1,20,000. 1,20,000 into 30 rupees per unit into 1 by 12. For all the overheads they are given 1 month. Average time in lag in payment of all overheads is 1 month. So both administrative and overhead and selling and distribution overhead is 1 month. So 1,20,000 into 30 into 1 by 12. In respect of amount column put 3 lakhs. Put 3 lakhs. Now total the current liabilities. Total the current liabilities. You will get 24,25,000. 24,25,000. in respect of that total within bracket B, total within bracket B. So below that, below that capital C, below that capital C, net working capital, net working capital. Open a bracket, capital A minus capital B. Open a bracket, capital A minus capital B. Now close the bracket. Now calculate what is the current assets. Total current assets is 95 lakh 12,250 and total current liabilities is 24 lakh 25,000. Now reduce it. You will get 70 lakh 87,500. 70 lakh 87,500. 70 lakh 87,500. So we have calculated net working capital. That is the net working capital required. With this, we have completed the unit number 1, not the chapter. Only one unit we have completed. So we should move on to the next unit in the same chapter. That is receivables management. Okay, now we'll start off with unit number 2, receivables management. So in this unit number 2, what we are going to see is how to maintain this receivables management. What is receivables basically? Receivables is a debtors which we give as debt. Like we'll give credit, we'll sell the products on credit basis, where we'll be collecting the amounts from the debtors on giving them a certain period of time. Like suppose we are giving credit for 2 months, 3 months. So what is this different credit policies which are followed by the companies, and what are all the analysis which can be done using those credit policies? That is what we are going to see in this receivables management. So basically, receivable management means debtors, that is book debts which will arise in case of credit sales. That is receivables management. Whenever you are selling products on credit sales, then there is some receivables which are going to be received in future. That is called debts, book debts. And aspects of management of receivables. That is what are the different managements which can be done based on these receivables. One, credit policies. Decision on credit period to be allowed. That is, suppose it will be effective only if credit is given on 2 months rather than giving on 6 months. If suppose you are giving credit facility for 6 months, then your amount is going to get logged in as a debtor, and you are going to lose the opportunity cost on earning such investment. Opportunity cost on using those investment for earning some other returns. So suppose you have 1 lakh rupees, you are giving credit sales. Suppose you are giving 50,000 rupees as credit sales, and 50,000 rupees you are going to receive it after 6 months. So this period of 50,000 6 months for this 50,000 rupees, you are going to get lost of 15% return for that period from that amount. Not only 15%, some return which we will be expecting from that amount, which will get logged in as credit, like debtors. So this credit policies, how much period of time should be given allowed, that such policies can be framed using this receivables management. And credit analysis, decisions on whether credit can be extended to particular customer. That is, see, based on the receivables management of a particular customer, you can give a credit, extra credit period for a particular customer uh, who is loyal to you. So based on the credit analysis, you can give extra time. So control over receivables. If on this receivables management, what you can do is you can have a control over this receivables. Okay, this is receivables management. And what are the importance of receivables management in high investment, low investment? Suppose if large amount is tied up in sundry debtors, working capital requirements and consequently interest rate charges will be high. See, you have given 3/4 of the sales as credit sales. Then there is high investment in credit sales. So what will happen when there is a high investment in credit sales? Like when there is large credit sales, your investment will get blocked in credit sale, that is working capital. So based on that, your interest charges will also be very high. Whereas low investment, if the investment in sundry debtors are low, the sales may be restricted. That is, suppose you are not at all giving on credit sales, you are doing only cash and carry. Then what will happen is there will be only low investment, but on the other side there won't be much sales. Only when you give on credit, you can improve your sales. So cost of maintaining receivables. There are, see, for giving uh, products on credit itself is one expenses. That is, you are losing your other investment interest. On the other hand, you should maintain the receivables. That is, suppose you give out of 1 crore rupees, you gave 3 for that is 75 lakhs sales on credit. That is credit sales. So for collecting those credit sales, for making that account receivable, maintaining the accounts, for all those things, you should incur a separate cost. So what are the different costs? Is interest on investment. That is additional funds are blocked in receivables. See, suppose that 75 lakhs out of that 1 crore has been logged in credit sales. That is debtors. So you're losing the interest on investment. That is one cost. And the other cost is administrative cost. The administrative cost is maintaining the records of this debtors, making them regular calls. That is the delinquency cost and collection cost. Collection cost is nothing but you will be sending the employee to collect the debts from them, and some customers may repay it on time, but many customers won't repay it. So whenever you give on credit, that is whenever you are making a credit sales, there will be lot of investment in cost for maintaining this receivables. And defaulting cost is nothing but suppose a person is not repaying, a customer is not repaying the amount, then either you should classify it as bad debt, or you should take it to the court and and spend some legal charges to recover the amount from him. So these are the different cost of maintaining the receivables. And what are the benefits? Not only there is only disadvantages, there are also some advantages of maintaining receivables. That is, you can increase the sales. Suppose you have a good receivables management team. They told you that the team told you that if you give on credit the two for a month, then you can increase your sales by 50%. Then this will help to boost your sales. So increase in sales when you are maintaining good receivables management, then there will be increase in sales and there will be increase in profits. Like when there is increase in sales, there will be increase in profits and extra profits. That is, in certain circumstances, the firm may credit sales at a price which is higher than the usual cash selling price. That is, this is common thing. Suppose you are going and buying something on credit, then the price of that product will be more compared to the cash and carry price. So there will be an extra profit. And the size of accounts receivable is determined by number of factors. That is, whether your accounts receivable is large or small. It is determined on the basis of level of sales. That is, if your level of sales is out of total sales, if 3 by 4 is on credit sales, then it is higher, like size of accounts is high. And credit policies, that is, instead of giving for 1 month, 2 months, you are giving for 1 year, 2 year credit, then it is for higher accounts receivable. That size of accounts receivable is large. And term of trade is credit period and cash discount. There are two terms, that is credit period and cash discount. Suppose if you pay before 3 months for the 6 months credit period, you will get some discount. All these are terms of trade. These are the different size of accounts receivable. Like whether your accounts receivable is very large or small, it is determined on the basis of level of sales, credit policy, and terms of trade. And just go through this optimum size of receivables, optimum credit policy. What is this credit policy? Credit policy is nothing but how much of sales should be made in credit and how much of months should be given for this credit sales. How much credit period should be there. All these are credit policies. So now in this particular unit, what you're going to see is whether the credit sales done is good or not, and whether the term period which has been allocated is good or not, or whether it is acceptable to change from the present policy to new policy. All these three things you are going to see in this particular unit. So if you go through very easy chapter, like once if you understand itself, it's more than enough for this particular chapter. So we'll start off with problem number 1. Problem number 1, GP Limited is considering the revision of its credit policy with a view to increase its sales and profit. That is, GP Limited is a company who is revising its credit policy. That is, revising their time period and their credit sales in order to increase its sales and profits. So currently, all its sales are on credit. Right now, that is, existing policy is all sales are on credit and customers are given 1 month time to settle their dues. That is, all the 100% of sales is on credit and the customers are given 1 month time. That is existing policy, and it has a contribution of 40% on sales. Okay, it has a contribution of 40% on sales, and it can raise additional funds at a cost of 20% per annum. That is, see, contribution on sales, contribution ratio is 40%, which means actually you would have gone through this marginal costing. If contribution ratio is 40%, then variable cost ratio is 1 minus 40%. That is 1 minus contribution ratio is equal to variables ratio. So here contribution ratio is 40%. Then variable cost ratio is 60% on sales. So and it can raise additional funds at the cost of 20% per annum. That is the investment rate is 20% per annum. Cost of capital, that is you can raise other new funds at the rate of 20% per annum. That is the amount which is going to be get logged in the debtors. If that amount is used for any other purposes, that is if that amount is without, like if you are not using that amount for the credit sales, and if you are using that amount and investing somewhere, you will be receiving interest rate of 20% per annum. So whatever you are locking in the debtors, the opportunity cost, that is the interest rate for that particular investment which has been locked in the debtors is 20%. So the marketing director of the company has given the following options with draft estimates for the consideration. That is the marketing director of the team, that is marketing director of the MD of the company, he is giving 3 options, that is current position, option 1, option 2, option 3. So based on these 4 options, which is the best? They are like the decision should be taken by you based on the receivables management. So what are the data they have given? Sales under all the options, credit period for all the options, bad debts for all the options, and cost of credit administration, that is administration cost for different options. All these 4 are given. Advise the company to take the right decision. So they are asking us to evaluate the different credit policies, which is the better policy. Okay. So with this, we'll start the receivables management. Put the heading unit number 2, receivables management. Unit number 2, receivables management. Receivables management. Problem number 1. Problem number 1. Statement number 1. Evaluation of credit policies. Evaluation of credit policies. Evaluation of credit policies. Below that 5 columnar table. Below that 5 columnar table. First column particulars. First column particulars. Give some space. Give some nice space. You have to take down the calculations also. Give some nice space. Then current position. Second column current position. Third column option number 1. Fourth column option 2. And fifth column, last column option 3. Particulars, current position, option 1, option 2, and option 3. See how you should evaluate the credit policy is, if suppose you are evaluating a credit policy, first you should calculate what are all the benefits derived from that credit policy, and what are all the total cost incurred for deriving that benefits. If you reduce both, you will get the net benefit, and you should compare net benefit of all the options so that you can find which is the better option. So below particulars, put capital A. Below particulars, put capital A, benefits. Below particulars, put capital A, benefits. Below that benefits, small Roman number 1. See, what are all the benefits to be derived from these credit policies? Whatever the sales is happening into whatever the contribution ratio. So sales into contribution ratio, you will get total contribution. And from the total contribution, if you reduce the cost of credit, you will get the net benefit. So here benefits, under benefits, small Roman number 1, sales value. Under benefits, small Roman number 1, sales value. What are the different sales value they have given? For current position 200. For current position 200. For option 1, 210. For option 1, 210. For option 2, 220. For option 2, 220. For option 3, 250. So these are the different sales which will be done in the different position. That is, if you are going with the current position itself, you will be selling 200 units. That is 200 lakhs rupees of sales. And if you are opting for option 1, then 210 lakhs of sales. Option 2, 220 lakhs of sales. Option 3, 250 lakhs sales. So below that, point number 2, that is Roman number 2, profit volume ratio, PVR. Profit volume ratio. What is the profit volume ratio? Profit volume ratio is nothing but contribution ratio. They have given it as a contribution of 40% on sales. So profit volume ratio is 40%. So remaining 60% is variable ratio. You would have studied this in marginal costing. What you will do first is sales minus variable cost ratio. That is variable cost. You will get contribution. From that contribution, if you reduce the fixed cost, you will get profit. So this profit plus fixed cost is the contribution. So to calculate the total contribution, what they have given is profit volume ratio, that is contribution ratio. So contribution ratio is 40% on sales. So sales value below that, point number 2, that is statement of row number 2, profit volume ratio under all the options 40%. Under all the options 40%. And below that, small Roman number 3, total contribution. Small Roman number 3, total contribution. So multiply it. Sales value into profit volume ratio is the total contribution. So 200 into 40%. So current position 80. Current position 80. And option number 1, 210 into 40%, 84. Option number 1, 84. And option number 2, 220 into 40%, that is 88. 88. And the last column, option number 3, 250 into 40%, that is 100. Total contribution is 100. So 80, 84, 88 and 100. So these are the different benefits under each option. Below that, capital, leave one line gap below, and capital B. Capital B. Now you should calculate total cost of credit. That is, what are all the different costs you are incurring in order to make this sales. That is, what is the different cost for each policies which has been incurred for specifically for this credit policies. You are not going to add the variable cost, all the variable costs incurred for cost of production. You are going to deduct only the cost of credit, the cost which has been incurred for different credit policies. That cost, if you reduce, you will get the net benefit. So total cost of credit. Total cost of credit. Below the total cost of credit, small Roman number 1, bad debts. Small Roman number 1, bad debts. See, in the question, bad debts they have given as percentage of sales. So current position 2%. So 200 into 2%. So below that, and in current option, open a bracket. In current position, open a bracket, 200 into 2%. Close the bracket, put 4. In respect of that bad debts, 4. And for option 1, 2.5% is bad debts. So open a bracket, 210 into 2.5%. 210 into 2.5%. Close the bracket, put 5.25. 5.25. 5.25. So option number 2, that is bad debts is 3%. So open a bracket, 220 into 3%. 220 into 3%, close the bracket, put 66. 6.6. 220 into 3%. 6.6. Under option 2, 6.6. And last column, that is option 3, 5%. So within bracket, 250 into 5%. 250 into 5%, put 12.5. 12.5. This is the different bad debts. That is, for each position, that is for each option, bad debts is differing because you are going to give different credit period. Suppose the credit period is more, your chances of bad debts is also more. So see, your credit period is steadily increasing from 1 month to 1.5 months, 2 months and 3 months. Based on that, bad debts is also increasing, 2 to 2.5 to 3 to 5% of bad debts. So based on this, bad debts has been incurring. Like you are calculating this much is bad debts which cannot be recovered. So this is one cost. Bad debts is one cost. Now below that, Roman number 2, small Roman number 2, cost of credit administration. Small Roman number 2, cost of credit administration. That they have given directly. See, cost of credit administration. For maintaining this credit policies, that is for maintaining the receivables management, you have to incur some cost, that is administrative cost. So these are all the different costs under each option. For current position, that is 1.2. In respect of the cost of credit administration, under current position, put 1.2. Under option 1, 1.3. Under option 1, 1.3. Under option 2, 1.5. And under option 3, 3. Under option 3, it is 3 lakhs. So 3. So this is cost of credit administration. So below that, put small Roman number 3. Small Roman number 3. Interest on investment blocked in debtors. Very important concept. Interest on investment blocked in debtors. Interest on investment blocked in debtors. Below that, open a bracket. See, first I will explain you this. What is this interest on investment blocked in debtors? See, suppose you are giving 1 lakh rupees on as credit sales. Okay. If suppose instead of selling it on credit, you sold it on cash, then you would have received that 1 lakh on that particular day itself. Then you would have not lost any interest on that amount. That is, suppose 1 lakh rupees you gave on credit. If you have that 1 lakh rupees in your hand, you can invest it or you can repay your interest so that your interest cost will be reduced. That is, suppose your interest cost is 10%. So 1 lakh rupees you gave on credit. Time period is 2 months. For 2 months, you are going to pay 1 lakh into 10%. That is opportunity cost. If you have not given credit, you would have got that 1 lakh in your hand only on that particular day itself. So you wouldn't have paid that 1 lakh into 10%. That is 10,000, and that is 1 lakh into 10% into 1 by 12. Okay. So that for each month you wouldn't have paid interest cost. So whatever the amount is going and getting logged in this data, on that amount you should calculate the interest rate. What is the interest amount on the investment blocked in data? That is the cost of credit policy. That is also an cost of credit. Suppose you sold 1 crore rupees credit sales. That 1 crore rupees you are going to receive after 6 months. That is for credit of 6 months. So for this 6 months, you are going to lose 1 crore rupees interest on that 1 crore rupees of 10% per annum. See, I'll give you small example. We are starting a small business firm. Okay, I got 5 lakhs loan. I got 5 lakhs loan from some financier, and 5 lakh I am investing in a business, and entire 5 lakhs I am giving on credit sales. Understood? Entire 5 lakhs of products I am giving on credit sales. What happens is I am giving for 3 months. So for the 3 months, I'm going to pay interest cost for this financier. So 5 lakhs into 10% into 3 by 12. That is the total amount which I'm going to pay for this financier, which is been getting logged in the credit sales, that is debtors. If suppose I didn't go sell on credit, I didn't sold the products on credit, I sold on the cash and carry, then on the particular day itself I would have got 5 lakh rupees. Then 5 lakh rupees I would have repaid, so I wouldn't have paid the interest cost for next 3 months. So this is the simple concept. For the amount which is being getting logged in the debtors, for that amount you should calculate the opportunity interest cost. That's all. I explained so much for this particular, but this particular thing is the only concept in this receivables management. If you can understand this easily, then receivable management is done. Okay. So what is the formula? So what is the annual credit sales? That is total credit sales into credit period on which you are giving credit into what is the interest rate per annum. That is what is the cost at which you are getting the funds. So that is the interest rate. So if you multiply all these three things, you will get interest on investment blocked in debtors. Simple. Below that, open a bracket, write down annual credit sales into credit period into interest rate. Annual credit sales into credit period into interest rate. So for current question, calculate what is the annual credit sales? 200 lakhs. What is the credit period? 1 month. So 1 divided by 12 into what is the interest rate at which you are receiving the funds. They have clearly mentioned it can raise additional funds at a cost of 20% per annum. So into 20% per annum. So interest on investment blocked in debtors for current question is 3.33 lakhs. Simple. 3.33 lakhs. Okay, you understood. This is how you should understand the interest on investment blockchain data. If suppose instead of giving on credit sales, you didn't give on credit sales, and if you have paid a cash, if you have received a cash from them, if you have sold on cash sales, then you wouldn't have paid that interest amount to the financial. So you would have saved that interest cost. So that is the cost incurred because of giving on credit. Okay. Then option one. For option one, what is the credit total sales? Here 100% of the sales is credit sales. They are mentioning currently all its sales is on credit. So you should calculate total sales. If suppose only 50% means, then on this total sales you should take 50% credit sales. Here 100% is credit sales. So 210 into what is the credit period? 1.5 month. So 1.5 divided by 12 into 20% per annum. So 5.25. So option one in respect of that interest on investment blocked in data is 5.25 lakhs. 5.25. And for option two, 220 into 2 divided by 12 into 20%. That is 7.33. 7.33. And for option three, 250 into 3 by 12 into 20%. 250 into 3 by 12 into 20%. That is 3 lakhs. Sorry, that is 12.5 lakhs. 250 into 3% into 20%. Sorry, 250 into 3 by 12. Credit period is 3. 3 divided by 12 into 20%. That is 12.5 lakhs. So in respect of option 3, that is 12.5 lakhs. So these are the different costs incurred for credit sales, bad debts, cost of credit administration, and interest on investment blocked in data. Now total it. Total all the three things. Below that put total cost of credit. Total cost of credit. In respect of current question, total it 4 plus 1.2 plus 3.33. Put 8.53. In respect of the total cost of credit, 8.53. 8.53. Then option 1, 5.25 plus 1.3 plus 5.25. Put 11.80. 11.80 lakhs. Under option 2, 6.6 plus 1.5 plus 7.33. You will get 15.43. 15.43. Under option 3, 12.5 plus 3 plus 12.5. 12.5 plus 3 plus 12.5, you will get 28. You will get 28. So this is the total cost of credit. Total cost of credit. So you have calculated what is total benefit and total cost of credit. If you reduce both, that is from total benefits, if you reduce the total cost of credit, you will get the net benefit. So below that capital C, net benefit. Net benefit. Open a bracket, capital A minus capital B. Capital A minus capital B, close the bracket. So what is the total benefit for current question? 80 minus what is the total cost of credit? 8.53. So 80 minus 8.53, you will get 71.47. In respect of net benefit, current question, put 71.47. And for option 1, 84 minus 11.80, you will get 72.2. 72.2. Under option 2, that is 88 minus 15.43. 88 minus 15.43. You will get 72.57. 72.57. Under option 3, 100 minus 28. 100 minus 28. That is 72. Last column 72. So net benefit is 71.47, 72.2, 72.57, and 72. In these 4 items, under 4 options, which is giving larger benefit, that is which is giving higher benefit? Option number 2, that is 72.57. 72.57. So option number 2 is giving greater benefit. So below that comment. This is what you should find. That's all. This is the problem. You should calculate what is the benefit from the sales, and you should calculate what is the total cost of credit. In that, important thing is interest on investment blocked in data. If you reduce both, you will get net benefit. And if you compare the net benefit, you will get the best option. That's all. Comment. Below that comment, record it. Net benefit is comparatively higher under option 2. Net benefit is comparatively higher under option 2. Hence, it is admissible to GP Limited. Hence, it is admissible to GP Limited to extend 2 months credit. Under option 2, what is the credit period? 2 months. So, hence it is admissible. Hence, it's admissible to GP Limited to extend 2 months credit. To extend 2 months credit to the customers. To the customers. So one more important, very important thing which you should understand in this particular sum is, they didn't give, see, whenever you are making credit sales, okay, you are going to have that profit in item in that, okay. When you are making credit sales, the total sales value includes profit item. So sales value is a cost plus profit. So cost plus profit is the total sales value, and debtors interest cost you calculated on total sales value. That is the interest cost which you calculated, the opportunity interest cost you calculated on credit sales value. But whatever the investment which has been done for that particular credit sales, only that you should calculate. You should not add the profit item. But in this sum, they didn't give cost item. See, whenever you are see that I'll tell you this example. See, suppose you are making some credit sales. You are making some credit sales for 1 lakh rupees. In that 1 lakh rupees, 80,000 is the cost, 20,000 is the profit. Okay. So 80,000 is the only amount which you invested. So you got 80,000 as a loan from some other person, and you invested in this production, and you gave it on credit sales for 1 lakh. For that, you are going to give some time period of 2 months. For that 80,000 only, you are going to pay interest. That is, for that only 80,000 amount which has been invested, only for that you are going to lose the opportunity interest cost. That is that cost at which you are going to procure that funds. So 20%. So remaining 20,000 profit, you are not going to pay any interest cost. That is profit element. But in this sum, they didn't give the cost of investment. That is cost invested for that credit sales. They didn't give any amount. So we calculated directly on the annual credit sales. But this should always be the cost of credit sales. The goods which has been sold on credit, and whatever the amount which has been invested for making that credit sales. Suppose you invested 80,000 rupees and you add a profit of 20,000 rupees, you sold on credit for 1 lakh rupees. Only on that 80,000 rupees, you are going to pay interest, or you are going to lose that other opportunity interest cost. So this interest on investment blocked on data should always be calculated on cost of credit sales, cost on which goods has been produced for credit sales into credit period into interest rate. But in this sum, they didn't give cost element. They gave only sales value in lakhs. So we calculated directly on the sales. So that is what has been given in the note. So take down the note. Note, point number 1. In the given situation, total cost data is not provided. Total cost data is not provided. In the given situation, total cost data is not provided, and hence debtors are valued, on the basis of total sales value, and hence debtors are valued on the basis of total sales value. So if suppose cost item is given, then this interest on investment blocked in debtors should be calculated on cost of credit sales into credit period into interest rate. Whatever the amount you are putting in, on that only you are losing the opportunity interest cost. You are not going to lose on the profit. So that is the problem number 1. So with this, problem number 1 is over. Now problem number 2. Same kind of sum. SI Limited is marketing all its products through a network of dealers. All sales are on credit. Okay, all sales are on credit, 100% credit, done. And the dealers are given 1 month time to settle the bills. Present policy is 1 month credit and all sales are credit. The company is thinking of changing the credit period with a view to increase its overall profits. They are planning to change the credit period. The marketing department has prepared the following estimates for different periods of credit. That is, the marketing department is giving what is the different period of credit and what are the costs to be incurred for increasing the credit period. So that they are given in the tabular column. So based on this, you should evaluate all the policies and you should find which is the best proposal. Okay, done. What they are given in the tabular column? Particulars. Credit period 1 month, 1.5 month, 2 month, and 3 month. Sales 120, 130, 150, and 180 lakhs. Fixed cost which you are going to incur for different policies 30, 30, 35, and 40. And bad debts is 0.5%, 0.8%, 1%, and 2%. So this is the different information they have given. And the company has contribution sales ratio of 40%. Simple. The contribution ratio, that is the profit volume ratio, is 40%. Further, it requires pre-tax return of investment at 20%. That is, if suppose instead of putting the amount in this debtors, if they have invested somewhere, they would have got 20% return. So for that interest cost, you should calculate at 20%. Okay. Evaluate each of the above proposal and recommend the best credit period for the company. So you as a marketing department manager or cost and management accountant, you should tell which is the best proposal. Okay, so same method to put the heading problem number 2. Take notes. Problem number 2. Statement number 1. Evaluation of credit policies. Evaluation of credit policies. Evaluation of credit policies. Okay, below that 5 columnar table. Below that 5 columnar table. First column particulars. First column particulars. Second column present policy. Second column present policy. Third column plan 1. Fourth column plan 2. And fifth column is plan 3. So above that present policy, just write it in bracket 1 month credit, 1 month, and plan 1 is 1.5 month, and plan 2 is 2 month, and plan 3 is 3 months. This is for informational purpose. You will forget it if you don't see the, if you don't write that, you will just get confused. So, okay. Below that particulars, capital A. Below that particulars, capital A, benefits. How should we calculate benefits? We should calculate based on the marginal costing method. So previous sum, we had only profit volume ratio where we didn't have fixed cost. Now we have even profit volume ratio, that is 40%, and also we have fixed cost. Then we can find what is the profit itself. Sales into profit volume ratio, you will get contribution, and contribution minus this fixed cost, you will get profit. So simple, that is marginal costing, you should do it here. So below that benefits, small Roman number 1, sales value. Below that benefits, small Roman number 1, sales value. Sales value, what is the different sales value? Present policy 120, then 130, plan 1 130, plan 2 150, and plan 3 180. These are the different sales, 120, 130, 150, and 180. Below that, small Roman number 2. Small Roman number 2, variable cost. Variable cost. Variable cost. See, what is variable cost? 1 minus profit volume ratio, that is 1 minus contribution ratio is the variable cost ratio. So here contribution ratio is 40%. Then variable cost ratio is 1 minus 40%, that is 60%. So in respect of that small Roman number 2, variable cost, below that note it down. 1 minus profit volume ratio is equal to variable cost ratio. 1 minus PVR is equal to variable cost ratio. Close the bracket. Below that, take down. 1 minus 40%. 1 minus 40% is equal to 60%. 1 minus 40% is equal to 60%. So on this sales value, if you multiply 60%, that is variable cost. So what is the sales value for present policy? 120. 120 into 60%, that is 72. Present policy 72. Present policy 72. And plan 1. For plan 1, 130 into 60%. 130 into 60%, that is 78. 78, plan 1, 78. And plan 2, 150 into 60%. 150 into 60%, that is 90. 90 lakhs. And plan 3, 180 into 60%, that is 108 lakhs. 108. So what is the different variable cost for under different policies? 72, 78, 90, and 108. This is variable cost. And below that, small Roman number 3, fixed cost. Below that, small Roman number 3, fixed cost. Fixed cost. So what are the different fixed costs? They itself have given 30, 30, 35, and 40. Take down. Fixed cost, present policy 30, then plan 1 30, plan 2 35, and plan 3 40. Plan 3 40. Plan 3 40. Now below that, small Roman number 4, total cost. Small Roman number 4, total cost. Open a bracket. Small Roman number 2 plus small Roman number 3. Small Roman number 2 plus small Roman number 3. So small Roman number 2 plus small Roman number 3 is 72 plus 30. Present policy is 102. Present policy 102. Then plan 1, 78 plus 30, 108. Plan 2, 90 plus 35, 125. And plan 3, 108 plus 40, 148. 108 plus 40, 148. So this is the total cost of producing the product. So total sales value is 120 and total cost is 102. So below that, small Roman number 5. Below that, small Roman number 5, profit. Profit. Open a bracket. Small Roman number 1 minus small Roman number 4. Small Roman number 1 minus small Roman number 4. Close the bracket. So total sales value is 120 and total cost is 102. If you reduce both, you will get profit. So for present policy, 18. And for plan 1, 130 minus 108, that is 22. And for plan 2, 150 minus 125, that is 25. And for last column, plan 3, 180 minus 148, that is 32. 32. So profit for each policy is 18, 22, 25, and 32. So we have calculated what is the benefit derived from the each policies. So below that, B, cost of credit policy. Capital B, leave 2 lines gap. Below that, capital B, cost of credit policy. Cost of credit policy. Below that, small Roman number 1. Small Roman number 1, bad debts. Bad debts. See, in this problem also they have given percentage on sales. Bad debts as a percentage on sales. See, important thing is you should always see in what terms they have given. If it is percentage of sales or if it is in rupees value. If you are thinking that this is not on percentage on sales, and if you think if by chance in exam or due to the pressure you might take it as rupees itself. You might copy 2.5, 0.8, 1 and 2 directly. Don't do that. This is percentage of sales. You should only take in rupees value. So if they are given in percentage of sales, then calculate it and convert it into rupees value. Always see for the term in which they have mentioned the bad debt. So bad debts, 0.5% on 120, that is sales. So in respect of that bad debts, under present policy, open a bracket. 120 into 0.5%. 120 into 0.5%, close the bracket, 0.6. Above that, right, 0.6. And under plan 1, 130 into 0.8%. 130 into 0.8%. Sales into bad debt percent. So 130 into 0.8%, that is 1.04. 1.04. Under plan 2, 150 into 1%. 150 into 1%, that is 1.5. It is good to mention the calculations because you will not forget in while you are revising. Like if you are taking down the calculation amount, it will be easy for you to revise. You won't have to spend time finding what is this, what is that, how they calculated this in that way. Here also below that bad debt, just take down sales into bad debts percent. Below this bad debt, just take down, or left side of this bad debt, just take down sales into bad debts percentage. So under loss column, that is plan 3, 180 into 2%. 180 into 2%, that is 3.6. 3.6. So that is bad debts. So under bad debts, now small Roman number 2, interest on investment blocked in debtors. Interest on investment blocked in debtors. So see, last problem we calculated directly on the sales value, because the total credit sales value, because we don't know what is the total cost, because they didn't mention the fixed cost. So if they have given fixed cost, we would have calculated this interest on investment blocked in debtors using total cost itself, but they didn't give fixed cost for the previous sum, so we calculated directly on the annual credit sales. Whereas in this sum they have given us fixed cost, so we know now what is the total cost incurred for producing the products. So we know the total cost, so we should always calculate the interest on investment blocked in debtors using total cost. So point small Roman number 2, interest on investment blocked in debtors. Interest on investment blocked in debtors. Below that, open a bracket. Total cost into credit policy, that is credit period, not credit policy, credit period, into interest rate, So for present policy, what is the total cost? 102 into what is the credit period? Here credit period is 1 month for present policy, so 1 divided by 12 into what is the interest rate at which you could have earned some other interest. That is not like, instead of investing here, if you have invested somewhere, you would have got return of 20%, so into 20%, that is 1.7. so on in respect of present policy, record 1.7. And for plan 1, what is the total cost? 108. So 108 into credit period is 1.5 months. So into 1.5 divided by 12 into 20%, that is 2.7. In respect of plan 1, record 2.7. If you want it, you just take down in the bracket. That is 108 into 1.5 divided by 12 into 20%. 108 into 1.5 divided by 12 into 20%. And for plan 2, open a bracket, 125 total cost. 125 into 2 divided by 12 into 20%. 125 into 2 divided by 12 into 20%. That is 4.17. 4.17 lakhs. And for plan 3, last column, recorded below, within bracket 148. Total cost is 148 into 3 divided by 12 into 20%. That is 7.4. In last column, record 7.4 lakhs. Now total both. Total the bad debts and the interest on investment blocked in debtors. You will get total cost of credit. So below that record, interest on investment blocked in debtors, record total cost of credit. Total cost of credit, underline it, 0.6 plus 1.7. Total it 0.6 plus 1.7, that is 2.3. And 1.04 plus 2.7, 3.74. 3.74. And 1.5 plus 4.17, that is 5.67. 1.5 plus 4.17, that is 5.67. And 36 plus 7.4, that is 11. 36 plus 7.4, that is 11. So total cost of credit is 2.3, 3.74, 5.67 and 11. So now below the total cost of credit, leave one line gap and record capital C net benefit. Capital C net benefit. Within bracket capital A minus capital B. Within bracket capital A minus capital B. So now what is capital A? 18 minus what is capital B? 2.3. So 18 minus 2.3 is 15.7. In respect of present policy, net benefit is 15.7. And for plan 1, that is 22 minus 3.74, that is 18.26. Plan 1, 18.26. And plan 2, 25 minus 5.67, that is 19.33. 19.33. And for the last column, that is 32 minus 11, that is 21. Net benefit is 21. So the net benefit derived from different policies are 15.7, 18.26, 19.33, and 21. So comparatively, if we compare all the 4 policies, that is present policy and 3 plans, we are getting around 21 lakhs net benefit in plan 3. That is, plan 3 is giving comparatively higher net benefit. So below that, record comment. Net profit is comparatively higher. Net profit is comparatively higher. Net profit is comparatively higher under plan 3, and hence it is advisable to extend under plan 3, higher under plan 3, and hence it is advisable to extend 3 months credit period to customers. Under plan 3, what is the credit period? 3 months. So hence it is advisable to extend 3 months credit period to customers. 3 months credit period to customers. Hence it is advisable to extend 3 months credit period to customers. With this, we have completed problem number 2. Now move on to problem number 3. So problem number 3. First, we'll read the question. The following are the details regarding the operations of a firm during a period of 12 months. So they have given what is the operations of a firm. So the firm has did sales of 12 lakh rupees and selling price per unit is 10. So which means 1,20,000 units has been sold, and variable cost per unit is 7 and total cost per unit is 9. So total cost is 9 and variable cost is 7. So fixed cost is 2 and selling price is 10. Total cost is 10. 9. 10 minus 9, you will get 1 rupee profit. This is the analysis which we can do from this particular table. And next is credit period allowed to customer is 1 month. That is, it has been done credit sales and 1 month is given. The firm is considering proposal for more liberal extension of credit. That is, the firm is planning to extend the credit period, which will result in increase in average collection period from 1 month to 2 months. That is, presently they are giving on credit sales for 1 month. They are planning to extend it to 2 months. This relaxation is because of changing from 1 month to 2 months. This relaxation is expected to increase sales by 25% from the existing level. Now, suppose total sales is 1,20,000 units. It is going to extend by 25%. That is 125%. Now, 1,50,000 units will get sold in proposal if credit period is extended from 1 month to 2 months. Based on this, you are required to advise the firm regarding adoption of new credit policy, presuming that the firm's required return on investment is 25%. See, suppose you are investing, you are extending credit period from 1 month to 2 months. Because of that, sales is going up by 25%. Whereas there will be some amount which will get blocked as interest on investment blocked. That is, investment which has been blocked in credit debtors. So on that 25% you should calculate, because it is extended from 1 month to 2 months. You should add the interest cost that has been expended as blocked on debtors for 2 months, and you should reduce the 1 month. Previously it was 1 month and now it is 2 months. So you should calculate what is the net benefit derived from the proposal and whether it is advisable to adopt the proposal or to not to accept the proposal. So this is very small, easy sum. Take down. Take the notes. Problem number 3. Problem number 3. Statement number 1. Evaluation of extension of credit policy. Evaluation of extension of credit policy. Evaluation of extension of credit policy. Below that 4 columnar table. Below that 4 columnar table. First column particulars. First column particulars. Second column present policy. Above that within bracket 1 month, because present policy is 1 month. Above that within bracket 1 month. And third column is proposed policy. Third column is proposed policy. Above that, within bracket 2 months. And fourth column, that is last column, is increment. You should compare this present policy with proposed policy and see what is the incremental cost and incremental sales. So fourth column is increment. So you should calculate what is the present policy values and what is the proposed policy values, and you should compare proposed policy with the present policy and check what is the incremental benefit and what is the incremental cost. If there is incremental net benefit, then it is acceptable to accept the proposed new proposal. Below that particulars, now below that particulars, small a, total sales value. Below that particulars, small a, total sales value. Under present policy, what is the total sales value? 12 lakhs. They have already given it is 12 lakhs. So in respect of present policy, record 12 lakhs. In respect of proposed policy, record what is the increment in sales. Sales, this relaxation, that is extension of credit period from 1 month to 2 months, it is going to give 25% increase in sales. That is from 12 lakh, it will increase to 25%. That is from 12 lakh is the 100%. It is going to increase 25%. That is 12 lakh divided by 100 into 125. That is 15 lakhs. Below that 15 lakhs, just take down within bracket 12 lakhs into, here take down it 12 lakhs into 125 divided by 100. Close the bracket. In respect of total sales value, record 15 lakhs. 12 lakhs into 125 divided by 100. In respect of total sales value, record 15 lakhs. Now, what is the incremental value? Incremental value. Below that incremental, open a bracket, take down B minus A. B minus A. Capital B minus capital A. Under present policy, record capital A. Under present policy, within bracket, record capital A. And under proposed policy, record capital B. Capital B. And under increment, record capital B minus capital A. So it will be easy to understand when you revise. So under increment, record capital B minus capital A. So what is B minus A? 15 lakhs minus 12 lakhs. That is increment is 3 lakhs. Increment is 3 lakhs. So below that, record small b. Record small b. Total cost. Total cost. So here they are given the per unit cost. Using this, you should calculate what is the total cost. So total cost. Below that, first arrow mark, total variable cost. Below that, first arrow mark, total variable cost. Total variable cost. In present policies, within bracket first record, below within bracket first record 1,20,000 units. What is the total number of units? 1,20,000 units. 12 lakhs divided by selling price per unit is 10. So you will get 1,20,000 units. So 1,20,000 units into variable cost per unit is 7. So within bracket record 1,20,000 units into 7. So in respect of the total variable cost in present policy, record 8,40,000. Within bracket 1,20,000 into 7. So 8,40,000. Under proposed policy, below record 1,50,000 into 7. 1,50,000 into 7. So in respect of that second column, proposed policy, record 10,50,000. 10,50,000. So in respect of increment, what is B minus A? 10,50,000 minus 8,40,000. So in increment column, total variable cost, record 2,10,000. The incremental variable cost is 2,10,000. Below that, leave a line gap and record second arrow mark. Second arrow mark. What is the total fixed cost? Below the total fixed cost itself, record 1,20,000 into, open a bracket, record 1,20,000 into, open another small bracket, 9 minus 7. What is 9? Total cost minus variable cost. What is that? Fixed cost. Fixed cost is equal to total cost minus variable cost. So within bracket record 9 minus 7 and close the small bracket and close the bracket. Close the small bracket and also the big bracket. So 1,20,000 into 9 minus 7. What is 9 minus 7? 2 into 1,20,000. You will get 2,40,000. So in respect of present policy, 2,40,000. 2,40,000. And when fixed cost for a particular unit is 2,40,000, that is total fixed cost will not change even if the quantity changes. Whereas fixed cost per unit fluctuates even if there is change in total number of units. Simple man. In costing, you would have studied this in marginal costing. Fixed cost remains the same even if the quantity changes. So under present policy, 1,20,000 units also 2,40,000. Under proposed policy, total fixed cost is same 2,40,000. Fixed cost is not going to change based on the fluctuation, that is changes in number of units. Only variable cost changes. So fixed cost is 2,40,000 under both the policies. And so both the policies B and A is 2,40,000. So incremental cost is nil. Put nil. So now the total cost. So total variable cost plus total fixed cost. Below that, put total. Total. In present policy, 8,40,000 plus 2,40,000. Total 10,80,000. 10,80,000. And proposed policy 10,50,000 plus 2,40,000. 10,50,000 plus 2,40,000. That is 12,90,000. 12,90,000. And incremental cost, what is B minus A? 12,90,000 minus 10,80,000, which is 2,10,000. So if you come from this way or this way, it will be the same. So 2,10,000 plus 0, that is 2,10,000. So total is 10,80,000, 12,90,000 and 2,10,000 incremental cost. So this is total cost. With this, small b is over. Below that, leave one line gap and record small c. Small c, profit. Under particular column, profit. Within bracket, record small a minus small b. Small a minus small b. Done. Under present policy, what is the small a? 12 lakhs. And what is the small b? 10,80,000. So what is the profit? 1,20,000. 12 lakhs minus 10,80,000, that is 1,20,000. And under proposed policy, 15 lakhs minus 12,90,000. 15 lakhs minus 12,90,000, that is 2,10,000. 2,10,000. Under incremental, 3 lakhs minus 2,10,000, that is 90,000. 3 lakhs minus 2,10,000, that is 90,000. So the profit made from this product is 1,20,000 under present policy, and under proposed policy it is increased to 2,10,000. So total incremental profit is 90,000. So we have found what is the profit. From this, you should reduce the cost of credit policies. Whereas in this problem, they have not given any other bad debts or any other cost of credit, administrative cost of credit. Nothing has been given. Only interest on investment blocked in debtors is there as credit cost of credit. So below that, leave one line gap, record small d less interest on investment blocked in debtors. Interest on investment blocked in debtors. See, under present policy, what is the investment blocked in debtors? So below that, interest on investment blocked in debtors, take down this formula. In exam also you write this formula: total cost into credit policy into interest percent. Total cost into credit policy or credit period into interest percent. Close the bracket. So under present policy, what is the total cost? We have calculated 10,80,000. So 10,80,000 into, take down below here within bracket, 10,80,000 into, what is the credit period? 1 month. So 1 divided by 12 into, what is the required return on investment? That is 25% into 25%. That is 22,500 under present policy. So in respect of present policy, small d, record 22,500. Below that, within bracket, 10 lakh 80,000 into 1 divided by 12 into 25% and close the bracket. So 22,500. That is the interest on investment blocked in data under present policy. And for proposed policy, just calculate it. Within bracket, below within bracket, just take it 12 lakh 90,000 into, we are giving 2 months credit period. So 2 divided by 12, 12 lakh 80,000, 12 lakh 90,000 into 2 divided by 12 into 25%. That is 53,750. Take it down. Above 53,750. 53,750. So what is the incremental interest on investment blocked in data? What is the incremental cost? 53,000 B minus A, capital B minus capital A. 53,750 minus 22,500. So incremental interest on investment blocked in data is 31,250. In respect of incremental cost, record 31,250. In respect of incremental, last column, record 31,250. So with this, we have calculated interest on investment blocked in data. So below that, leave one line gap, record small e, that is net benefit. In particular column, record net benefit within bracket small c minus small d, small c minus small d, small c minus small d. That is 1,20,000 is the profit minus 22,500 is the investment blocked in data, interest on investment blocked in data. So 97,500 is the net benefit. 97,500 is the net benefit. And under proposed policy, profit is 2,10,000 and interest on investment blocked in data is 53,750. 53,750. So the net benefit is 1,56,250. 1,56,250. And for C, that is incremental profit is 90,000 and incremental cost on investment, interest on investment blocked in data is 31,250. So 90,000 minus 31,250. So total incremental net benefit is 58,750. So incremental net benefit is positive. Basically, if this number is negative, then the proposed policy should not be accepted. Whereas if it is in positive, it can be accepted because it is giving incremental benefit. So incremental net benefit is 58,750. Underline 58,750. So this proposed policy is giving a positive net benefit, that is incremental net benefit of 58,750 rupees. So it is advisable to accept the policy. So take down these notes if you want. Existing sales in units is 12 lakh divided by 10, that is 1 lakh units. How we calculated 1 lakh unit? 1,20,000 units is 12 lakh divided by 10. And increasing sales units is 1,20,000 into 25%, that is increase. So 30,000 units. So 30,000 units has been increased. So total sales under new policy is 1,20,000 plus 30,000, that is 1,50,000 units. So new sales in units, that is proposed sales in units is 1,50,000 units. And what is the total existing fixed cost? Total cost 9 minus variable cost 7. So 9 minus 7 into sales in units, that is 1,20,000. Existing sales in units is 1,20,000. So 2 into 1,20,000 is equal to 2,40,000 units. Sorry, 2,40,000 rupees. That is the total existing fixed cost. This is the notes. It's advisable to write these notes in the exams too. So next is comment. Record comment. Comment is incremental new benefit is positive. Incremental new benefit is positive. Hence, it is advisable. Hence, it is advisable to the entity. Hence, it is advisable to the entity to extend the credit period. To extend the credit period for 2 months under the new policy. For 2 months under the new policy. For 2 months under new policy. So with this, we have completed problem number 3. So all these 3 sums are basic sums, which actually these types of sums will be asked in exam. Whatever we have solved till now. Okay, that is 3 sums we have finished. So now we will move on to next sum. That is problem number 8. Come to problem number 8. Examination sum. Similar sum. Similar kind of sum. Okay, man. First we'll solve the question, then we'll come to solution. Problem number 8. A company manufactures a small computer component. There is a company manufacturing small computer component. The component is sold for 1000 and its variable cost is 700. Simple. Total selling price per unit is 1000 and variable cost is 700. So contribution is 300. The company sold on an average 300 units every month in 2014-15. That is, for every month sales is 300 units, which means for a year it is 3600 units, 300 into 12. And at present the company grants 1 month credit to its customers. Right now the company is giving 1 month credit period to its customers to settle the sales value, whereas the company plans to extend the credit to 2 months, on account of which following is expected. See, right now it is giving 1 month credit period, whereas it is planning to give 2 months credit period. The proposed policy is for 2 months credit period. And because of extending this credit period to 2 months, what are the following are expected? What is the increase in sales is 25%. Okay, increase in sales is 25%. And increase in stock is 1,50,000. Increase in stock is 1,50,000. And increase in creditors is 60,000. See, when there is increase in stock, that is the closing stock to be maintained increases from current position to new position, and the incremental cost is 1,50,000. So I am going to put in extra working capital. That is, I am going to levy extra working capital of 1,50,000, whereas I am getting a benefit of from the suppliers of 60,000. If I am extending to 2 months, my creditors are giving increase in credit for credit, that is credit value of 60,000. Suppliers are giving me extra 60,000 of time. That is 1,50,000 I am going to dump in working capital, whereas 60,000 I am going to take out from working capital. Net benefit is 90,000 I am going to invest more in working capital. So that is one cost. And another cost is, what is the interest cost? That is interest on investment blocked in data. So these are the two costs which will be incurred for extending time period from 1 month to 2 months. Increase in stock is 1,50,000 and increase in creditors is 60,000. Should the company extend if credit terms if all customers availing the extended period of 2 months, that is existing customers as well as this 25% new customers, they both are availing the 2 months credit period. Or the second option is, that is second thing is, if credit terms are only new customers can avail 2 months credit, assuming that increase in sales is due to new customers. That is, this 2 months credit period is given to new customers of 25% sales. That is 3,600 into 25%. That is 900 units being sold in for 2 months credit, and remaining 3,600 units being sold on 1 month credit itself. So these are the two situations. We should calculate what is the incremental benefit for both the situations. And the company expects a minimum rate of return of 30% on its investment. Okay, this, if suppose instead of putting here, if that amount has been invested somewhere else, they would have got return of 30%. So interest is 30%. Consider debtors at sales value. That is, consider entire sales as credit sales. So this is the examination problem. Okay, done. Now we'll take down the solution. Simple. They have asked us to calculate in two situations, whether it is net benefit or not, to accept the new proposed policy. Take down problem number 8. Problem number 8. Statement number 1. Evaluation of credit policy. Statement number 1. Evaluation of credit policy. If I fund, first we'll do for first situation. That is, all customers availing extended period of 2 months. I fund if all customers avail 2 months credit. If all customers avail 2 months credit. So below that, 3 columnar table, that is particulars, amount and amount. Particulars, amount and amount. Below that particulars, take down capital A. Capital A. Incremental contribution. Incremental contribution. They have given contributional, see, 700 rupees is the variable cost. Total selling price is 1000. So 1000 minus variable cost 700, this is 300 is the contribution. So in this particular problem, how we are going to evaluate is, we are not going to do separately what is the present policy, what is the proposed policy, then incremental policy, what is the increment. Previous sum we did it in that model. This sum we are going little advanced. What we are doing is, we are directly calculating the incremental. So how to calculate this directly? This incremental is, this sum, it has been solved in that method. Capital A, incremental contribution. Capital A, incremental contribution. Below that, small Roman number 1. What is the incremental sales in units? Small Roman 1, right? Incremental sales in units. Incremental sales in units. So here, incremental sales in units is, total sales is 300 into 12. That is, total sales is 3600. From this, the company is expecting to increase in sales is 25%. So into 25%. So total increase in sales in units is, inner amount column put 900 units. First, incremental sales in units. Open a bracket. Open a bracket. 300 into 12 months into 25%. So inner amount column put 900 units. Inner amount column put 900 units. Below that, small Roman number 2. That is contribution per unit. Small Roman number 2, contribution per unit. Open a bracket. What is the selling price? 1000. Minus what is the variable cost? 700. So within bracket, 1000 minus 700. That is, inner amount column put 300 rupees per unit. 300. Contribution per unit is 1000 minus 700. That is 300. So now calculate what is the total incremental contribution. So 900 into 300, that is 2,70,000. Below that, underline it, outer amount column, put 2,70,000. Below that, total it, and outer amount column, 2,70,000. In respect of the 2,70,000, put small Roman number 3, incremental contribution. Incremental contribution. Within bracket, small Roman number 1 into small Roman number 2. So how much is the incremental contribution? 2,70,000. Below that, leave one line gap and record capital B. Capital B. Incremental cost. So, like how we calculated incremental contribution by comparing the proposed and present policy, incremental cost also we can do it directly. How we should do is, we should add the new interest cost and we should deduct the old interest cost. That way we can easily find the incremental cost. So I'll just solve it, you will understand it. Below that incremental cost, put small Roman number 1. Below that incremental cost, put small Roman number 1. Interest on debtors as per new policy. Interest on debtors as per new policy. Interest on debtors as per new policy. So see, how much is the interest on debtors as per new policy? Total sales is 3,600 plus 900 units increment. So 4,500 units I'm selling. Okay. At what value I'm selling? Here, if they have given fixed cost value, I would have taken this at cost itself. That is cost of goods sold itself. Whereas here the fixed cost value is not given. So I am going with the sales value itself. For calculating the interest on debtors as per new policy, like how we did in the first sum, if there is cost amount, then you can take the total cost value itself. If there is no total cost value, you should definitely take the average, that is total sales value. Here the total sales value is 4,500 units into 1000. 4,500 units into 1000, that is 45 lakhs into what is the new credit, all customers to avail extended period of 2 months. So into 2 divided by 12 into what is the percentage of return on investment? 30% into 30%. So under present policy, below that recorded, open a bracket, 4,500 units into 1,000 rupee per unit. Selling price per unit is 1,000. So that we'll get total sales value 4,500 into 1,000 into credit period under new policy is 2 divided by 12 into return on investment is 30%. Now close the bracket. This is the interest on debtors under new policy. So inner amount column, put 2,25,000. 2,25,000. And what you should do is below that calculate, put small Roman number 2. Small Roman number 2, interest on debtor as per old policy. We should detect the interest on debtor as per old policy so that we can find the incremental cost. So below that record interest on debtors as per old policy. What is the old policy here? They are selling 300 units every month. So 300 into 12 is 3,600 units they are selling at a rate of 1,000 rupees. So into 1,000, they are giving, presently they are giving 1 month credit to its customers. So 1 divided by 12 into what is the return expected? 30%. So this is the existing interest on debtors has been blocked as per old policy. Okay, interest on investment blocked in debtors as per old policy is below that record, open a bracket, 3,600 units is previously sold as per old policy into what is the selling price? There is no change in price. So 1,000 rupees, 3,600 into 1,000 into existing credit period is 1 month. So into 1 by 12 into return on expected is 30% return on investment. So into 30%. Now close the bracket. So this is the interest on debtor as per old policy. We calculated interest on debtor as per new policy, and if we are deducting interest on debtor as per old policy, we'll get the interest on debtors incremental. That is increase in interest on debtors because of change in policy. We'll get that by deducting the interest on debtors of old policy from the new policy. So old policy is 90,000 inner amount column within bracket. So 2,25,000. 2,25,000 minus 90,000 which is old policy. So incremental below that small Roman number 3, below that small Roman number 3, incremental interest on debtors. What we are doing in this sum is instead of doing it in 3 separate columns, we are just combining it and doing it in a single column. That's all. So interest on, incremental interest on debtors. Small Roman number 3, incremental interest on debtors within bracket small Roman number 1 minus small Roman number 2. That is 2,25,000 minus 90,000. Outer Roman column record 1,35,000. In respect of the small Roman number 3, outer Roman column record 1,35,000. 1,35,000. Now below that small Roman number 4. Very important point. This actually they didn't explain this, like it was not there in institute book before they asked in exam. Once after they asked this entry in exam, then only they added this in institute book itself. So this interest on increase in working capital, that incremental working capital, you should deduct it. This is increasing only because of change in credit policy. So you should deduct this also. So this has been new entry which has been added from now, but this has been added in institute book and sir added it in June 2000, that is December 2015 exam itself. That time itself, whenever a new sum is coming, he will add it in the book so that the new entries which they are, new experiments which they are doing in the exams, you come to know, like you will come to know whether if you go with the institute book, the problem is it is like same problems which has been continuously asked in exams, that they'll keep it there. Whatever the new problems, new entries which they are doing, they won't add it immediately. That is the problem with the institute book. I'm not telling institute book is not enough, but it is more than enough. But then in this material, like in GCRF Academy material, you will find it, all the exam sums, recent exam sums, you will find it in the material, like GCRF Academy material. So small Roman number 4, interest on incremental investment in net working capital. Interest on incremental investment in net working capital. You simply do it like calculate the incremental net working capital. Suppose increase in stock. So in current assets, you will put 1,50,000. So below that increase in creditors. So in current liabilities, you will put 60,000. So current assets minus current liabilities, that is 1,50,000 minus 60,000. So 90,000 is the net working capital. So when these both are incremental, so that net working capital is also an incremental. So interest on incremental in net working capital. Interest on incremental investment in net working capital. So you are investing 90,000 extra in incremental capital. So open a bracket 1,50,000. Below that open a bracket 1,50,000 minus 60,000. Minus 60,000, that is 90,000 into 30%. into 30%. This 27,000 is interest amount which is being blocked because of increment in credit policy, because of increase in credit period. So this 27,000 record it in the outer column. Statement number small Roman number 4, interest on incremental investment in net working capital 27,000. Now total the incremental cost 27,000 plus 1,35,000. So the total cost is 1,60,000. Underline it, total cost is 1,62,000. So that is incremental cost, that is capital B. Now below that record capital C. Below that record capital C, net benefit within bracket capital A minus B, capital A minus capital B. So 2,70,000 is the capital A minus 1,62,000 is the capital B. So the incremental net benefit is 1,08,000. So there is a positive net benefit, that is there is an incremental net benefit. So hence it is acceptable to accept the proposal, that is first proposal. First proposal is all customers availing the extended period of 2 months. It can be accepted because the net benefit is 1,08,000. So comment. Below that record the comment. There is incremental net profit. There is incremental net profit, that is net benefit. There is incremental net benefit, comma, hence it is advisable. Hence it is advisable to extend the credit policy. Hence it is advisable to extend the credit policy to 2 months. To 2 months to all customers. To all customers. To all customers. So situation 1 is over. Now record situation 2. Now below that leave one line gap and record statement number 2. Statement number 2, evaluation of new credit policy. Evaluation of new credit policy. Hyphen if only new customers avail 2 months credit period. What is the situation 2? Only new customers avail 2 months credit period, assuming that increase in sales is due to new customers. So hyphen if new customers avail 2 months credit period. New customers avail 2 months credit period. Below that 3 columnar table. First column particulars, second column amount, and third column also amount. First column particulars, second column amount, and third column also amount. So what is the incremental contribution? We have already calculated because of increase in sales. What is the incremental contribution? That is incremental contribution is 2,70,000. Whether you are doing it in this way or whether you are existing sales is 3,600. Present sales is 4,500. So 4,500 minus 3,600. So total increase in sales is 900 into what is the contribution? 300. So if you multiply 2,70,000. So incremental contribution is same under 2 policies. So under particular small a, incremental contribution within bracket refer statement number 1. Within bracket refer statement number 1. Outer amount column record 2,70,000. Outer amount column record 2,70,000. Below that small b. Below that small b, incremental cost. Incremental cost. But incremental cost will vary because when entire customers are availing 2 months credit and only few customers are availing 2 months credit, there will be change in incremental cost. So below that incremental cost, small Roman number 1. Incremental interest on investment blocked in investment block. That is incremental interest on investment block. See, new customers are coming in, they are purchasing 900 units and they are availing 2 months credit period. So this entire chain itself is incremental. They are coming in, purchasing 900 units and they are getting 2 months credit period. So this is one chain and old customers are going in the same line. That is 3,600 units is being sold to the old customers for 1 month credit. So that is one chain and this is one chain. So we can directly calculate the incremental interest on investment blocked in data. That is, see 900 units, sales value. We are doing it on sales value because cost value is not provided. Because fixed cost is not provided. So 900 into 1000 into only this 900 customers are availing 2 months credit. So 2 months divided by 12 months into 30%. So the interest on incremental interest on investment blocked in debtors is 45,000. 45,000. So incremental interest on investment blocked in debtors. Under incremental cost below that small Roman number 1, incremental interest on investment blocked in debtors. Incremental investment interest on investment blocked in debtors. Open a bracket. 900 into 1000 into 2 by 12 into 30%. 900 into 1000 into 2 by 12 into 30%. Close the bracket. Inner amount column record 45,000. Inner amount column record 45,000. And below that, small Roman number 2, interest on investment blocked in net working capital. Interest on investment blocked in net working capital. Even though if there is only new customers availing this credit period 2 months, this investment which has been getting blocked in the working capital will have some interest component. That interest component is the incremental cost. So same, copy it from the above table. Problem number, sorry, small Roman number 2, increment interest on investment blocked in net working capital. Incremental interest on investment blocked in net working capital. What we have calculated here, 1,50,000 minus 60,000 into 30%, that is 27,000. Below that record, within bracket, statement number 1. Refer statement number 1. Refer statement number 1. Close the bracket. Inner amount column record 27,000. Inner amount column record 27,000. So this 45,000 plus 27,000 total is 72,000. So this is the total incremental cost for this new credit policy under situation 2. If only new customers are availing 2 months credit. So underline it. Total the inner column. In the outer amount column, put 72,000. In the outer amount column, put 72,000. So now total the total outer amount column, that is 2,70,000 minus 72,000. 2,70,000 minus 72,000. That is 1,98,000. Outer amount column total it 1,98,000. So in respect of that 1,98,000, put capital C. Capital C. Incremental net benefit. Incremental net benefit within bracket A minus B. Capital A minus capital B. Within bracket capital A minus capital B. So in this situation also we are getting some positive net benefit. So below that comment is same. In first situation also there is incremental net profit, that is net benefit. So hence it is advisable to extend the credit policy to 2 months to all customers. Here there is incremental net benefit, hence it is advisable to extend the credit policy to 2 months to only new customers. Both are having positive net benefit. Whereas in this particular sum, they didn't ask us to compare the new policies. See, if they have asked us to compare the new policies, then we have to compare this net benefit 1,08,000 and the net benefit 1,98,000. Comparatively, situation 2, that is only new customers to avail new 2 months credit will be more beneficial. Okay, so if they have asked us to compare the proposed policies, then you should give a comment as situation 2, that is only new customers should avail 2 months credit policy. It is more beneficial. Whereas they asked us to evaluate both the policies. So under situation 1, it is acceptable. That proposed policy is acceptable. Under situation 2 also proposed policy is acceptable. So this is problem number 8. With this we have completed problem number 8. Now problem number 4. First we'll read the question. Problem number 4. TT Limited currently sells on terms of net 30 days. That is, right now it sells on terms of net 30 days. All the sales are on credit basis and average collection period is 35 days. Okay. All the sales are, point number 1 is all sales are credit sales, and second is collection period is 35. That is, debtors are allowed for 35 days. And currently it sells 5 lakh units at an average price of 50 per unit. So 5 lakh units sold at 50 per unit. So total sales is 2 crores 50 lakhs. Total sales is 2 crores 50 lakhs. And the variable cost to sales ratio is 75%. That is, see, variable cost ratio is 75%. Then contribution ratio is 1 minus variable cost ratio. That is 25%. Contribution ratio is 25%. And bad debt to sales ratio is 3%. That is, whatever the sales value on that 3% will always go as bad debts, which should be reduced. In order to expand the sales, the management of the company is considering changing the credit terms from net 30 to 2 by 10 net 30. Net 30 to 2 by 10 net 30. Due to change in the policy, sales are expected to go up by 10%. Bad debts loss on additional sales will be 5%. And bad debts loss on existing sales will remain unchanged. See, sales are going to go up by 10%. So existing sales, that is 5 lakh units, bad debts will be 3%. And that incremental sales, that is increase in sales 10%, that is 50,000 units, bad debts will be 5%. 40% of the customers are expected to avail the discount and pay on the 10th day. So basically this 2 by 10 net 30 is nothing but if they pay in 10 days, they are going to get discount. So if they are not paying in 10 days, they are not going to avail any discount. This is a new proposed policy. Okay. So only 40% of the customers, that is 40% of the debtors are paying the amount within discount day, that is within 10th day. And the average collection period for the new policy is expected to be 34 days. For old policy, it is 35 days. And for new policy, it is 34 days. Once again. Okay. For old policy, it is 34 days. Sorry, collection period is 35 days. And for the new policy, it is expected to be 34 days. So we should go with the total number of days. We should not go with the months. We should go with the days. That is 365 days. The company required a return on investment of 20% on its investment in receivables. That is, it is expecting 20% return on investment. You are required to find out impact of change in credit policy of the profit of the company. That is, because of this change in policy, what is the impact on the profit? Ignore taxes. So this is the problem number 4. First, just take down this working notes. These working notes are to understand. You should not write this in exam. You just go with the answers only. But then take this working notes to understand the problem. Problem number 4, working notes. Beginning itself, write working notes. Divided into 2 parts. Left hand side present and right hand side required. Left hand side present and right hand side required. That is, required is nothing but proposed policy. Present policy credit period is 30 days. Present policy is 30 days. And required policy is 2 by 10, 30 days. That is, if you repay in 10 days, you will get a discount of 2%. So 2 by 10, 30 days. Proposed policy. Below that, average collection period. Average collection period is under proposed old policy 35 days. Under present policy, average collection period is 35 days. Average collection period is equal to 35 days. And under required, that is new policy, 34 days. Right? 34 days. Under new policy, 34 days. And sales value, that is sales in units, is under present is 5 lakhs. Sales units under present is 5 lakhs. Under proposed is 5 lakhs into 110%. 5 lakhs into 110%. That is 5 lakh 50,000. Under new policy, 5 lakh 50,000. So incremental sales is 50,000. Below that, selling price. Here selling price is 50 rupees. Selling price is 50 rupees. And variable cost ratio is 75%. Variable cost ratio is given is 75%, which means contribution ratio is 25%. And bad debts under present policy is 3%. Bad debts under present policy is 3% and interest rate is 20%. And interest rate is 20%. Whereas under required, that is new policy, bad debts for existing sales is 3%. Bad debts, arrow mark, existing is equal to 3%. And for 50,000 units, that is incremental sales, that is equal to 5%. For that 50,000 units alone, 5%. And 40% of the customers, 40% of debtors paid in 10th day. So discount is equal to 2% for that 40%. That is, suppose 5,50,000 units into what is the sales value? 50 into 40% they are paying. That is 1 crore 10 lakh they are paying on 10th day itself. So 2% on that. That is 2,20,000 will be given as discount. So this is cost incurred. So this is discount. So this is the explanation of the sum. How to understand the sum. If you have this only, you will understand the sum when you are reading it after a month or during exams. So if you are not having it, it will be difficult to understand the problem. So below that, so now simple. They have given us the benefit data and cost data. We just have to calculate what is the incremental thing. We don't have to calculate all the data, that is present, future, like present policy, proposed policy, what is the increment, that is not required. We just have to calculate incremental things as benefit and cost so that we can find out incremental net benefit. So below that, put the heading, statement number 1, evaluation of new credit policy. Evaluation of new credit policy. Below that, 3 columnar table. Below the 3 columnar table, first column particulars, second column amount, third column also amount. Particulars, amount and amount. Under particulars, capital A, benefit. Under particulars, capital A, benefit. Below that, benefit, put small Roman number 1, increase in sales in units. Increase in sales units. Inner amount column, how much is the increase sales? 50,000. That is 5 lakh into 10%. 50,000. Small Roman number 2, contribution. What is the contribution? 1 minus variable cost. That is 100 minus 75 is 25%. So variable cost ratio, contribution ratio is 25%. So selling price per unit is 50 into 25%. Within bracket 50 into 1 minus 75%. You just record it like that. Within bracket 50 into small bracket 1 minus 75%. Close the small bracket and close the bracket. That is 50 into 25% is 12.5%. Inner amount column record 12.5%. And below that, small Roman number 3, incremental contribution. Incremental contribution. So now multiply it, 50,000 into 12.5%, 12.5 rupees. That is 6,25,000. Outer amount column record 6,25,000. Incremental contribution, outer amount column record 6,25,000. Below that, record, leave one line gap and record capital B. Capital B, incremental cost. Incremental cost. Capital B, incremental cost. So incremental cost, below that record small Roman number 1. Incremental bad debts. Incremental bad debts. See, bad debts for existing sales is same as 3% for previous policy, that is present policy, and also for proposed policy it is 3%. But for existing sales it is not but for incremental sales it is not 3%, it is 5%. So only this incremental bad debts we should calculate. Below that incremental bad debts record within bracket 50,000 into 50, close the bracket, into 5%. 50,000 into 50 into 5%. Inner amount column here. Inner amount column record 1,25,000. Inner amount column record 1,25,000. And small room below that small room number 2. Incremental discount offered. Because of giving this discount and because 40% are paying it before 10th day, you are giving 2% discount. And 2% discount is cost to us. So that incremental discount offered is also form part of incremental cost. So small Roman number 2, incremental discount offered. Incremental discount offered. Below that within bracket 5,50,000 5,50,000 total sales into 50 rupees per unit, close the bracket, into 40% into 2%. So inner amount column record 2,20,000. So that is the increasing discount, incremental discount offered. So 2,20,000 inner amount column recorded. See, you are giving within, suppose within 10 days, if someone is repaying me back, I'll give you 2% discount. You are saying to customers, and customers, 40% of the customers, they are coming and repaying it, and you are giving discount to them. So from the sales value, you should deduct the discount offered. So that is why you are deducting it in the incremental cost. You are adding it in the incremental cost and deducting from the benefits. So incremental discount offered is 2,20,000 inner amount column. So below that, small Roman number 3. Small Roman number 3, incremental interest on debtors. Small Roman number 3, incremental interest on debtors. Incremental interest on debtors, that is one second. Okay. See, we have got one point here, that is when we are selling extra units, that is when we are increasing the sales, then fixed cost is going to remain the same. Only the variable cost is going to fluctuate. Okay. So the variable cost only you are going to incur for the additional sales. You are not going to incur the fixed cost. So in this problem, what they have did is incremental interest on debtors, that is on new policy and old policy you are calculating. Okay. So as per new policy, incremental interest on debtors is on 5 lakh units, you are calculating on the sales value, that is 50 rupees selling price. Whereas for 50,000 additional units, you are calculating on only variable cost, because you are going to incur only variable cost. You are not going to incur fixed cost. So here we don't know the fixed cost amount. So we are taking the total selling price. Whereas here we know that we are not going to incur any additional fixed cost. So we are taking it on variable cost. That is 50 into variable cost ratio is 75%. That is 37.5. Can you understand? Incremental interest on debtors, we should always calculate on the cost. That is total cost that has been put in for the debtors. That on that amount only you should calculate the interest on incremental debtors. But interest on debtors, we should always calculate on the total cost. Whereas if we don't know the fixed cost, we'll calculate on the sales. Okay. So here we are calculating on the sales because we don't know the fixed cost. Whereas for additional sales quantity, we know that there is no fixed cost. So we are calculating on the variable cost ratio. Simple. Below that, Roman number 3, small Roman number 3, interest on incremental interest on debtors within bracket 5 lakhs into sales selling price, because this 5 lakhs we don't know what is fixed cost. So 5 lakhs into selling price, that is 50 into, under new policy, what is the period? 34 days into 34 divided by 365 into what is the return expected? 20% into 20%. So 5 lakhs into 50 into 34 divided by 365 into 20%. That is inner amount column record 4,65,753. 4,65,753. 4,65,753. And below that, small Roman number 4. Small Roman number 4. For this additional sales quantity, we are not going to incur any fixed cost. So now we know that 75% is the variable cost and remaining amount is totally profit, because there is no fixed cost incurred for the additional sales. Additional sales, we are going to incur only variable cost. Variable cost will incur, will produce the product and will sell it in the market, because fixed cost it's already incurred. So small Roman number 4, on additional incremental interest on debtors on additional sales quantity. Incremental interest on debtors on additional sales quantity. Below that, open a bracket. Additional sales unit is 50,000. So 50,000. What is the cost incurred? 37.5. previous entry we don't know what is the cost incurred, so we took sales value. Here we know what is the cost incurred, that is 37.5, because there is no fixed cost. So 50,000 into 37.5 into 34 divided by 365 into 20%. So inner amount column record 34,932. Inner amount column record 34,932. So we added the total interest on debtors from new policy. Now we should deduct the interest on debtor as per old policy. Actually, see, remove the incremental word from both the point number 3 and point number 4. In small number 3, remove the incremental word. It is just interest on debtor as per old policy and interest on debtors as per old. Sorry, wait. Under Roman number 3, small Roman number 3, remove the incremental word. It is interest on debtors as per new policy. Interest on debtor as per new policy, and below that interest on debtors as per new policy on additional sales quantity. Remove the incremental word because we are totally adding both and removing the old one. We are adding the total interest on debtors as per new policy and we are deducting the interest on debtors as per old policy. So we added 4,65,753 and 34,932 inner amount column. Now just leave and come to small Roman number 5. Small Roman number 5. Don't add and all. Just inner amount column put 1,25,000, 2,20,000, 4,65,753 and 34,932. Below that small Roman number 5. That is interest minus, within bracket put less, interest on debtors as per old policy. Here we are adding the new policy interest on debtors and we are deducting the old policy interest on debtors. So that what we will get, we'll get the incremental interest on debtors. So below that small Roman number 5 less interest on debtors as per old policy. Below that open a bracket, 5 lakhs, what is the old policy? 5 lakh units into 50 rupees per unit into 35 divided by 365 into 20%. Within bracket 5 lakh into 50%, 50 rupees into 35 divided by 365 into 20%. Inner amount column within bracket record 4,79,452. Inner amount column within bracket record 4,79,452. 4,79,452. See, this one you should write it within bracket. Okay. This one write it within bracket. So now total the inner amount column. 1,25,000 plus 2,20,000 plus 4,65,753 plus 34,932 minus 4,79,452. So now outer amount column record incremental cost. Outer amount column, underline it, outer amount column record incremental cost. Incremental cost, that is 3,66,233. Don't write this, just total. Underline here and record outer amount column 3,66,233. That is the incremental cost. So incremental contribution is 6,25,000. Incremental cost is 3,66,233. That is total incremental cost. Don't write this 21,000 and all. We have directly did this inside a table itself. So total incremental cost is 3,66,233. So below that leave one line gap and record capital C. Capital C, net benefit. Net benefit within bracket capital A minus capital B. Now what is capital A? 6,25,000. 6,25,000 minus 3,66,233. So net benefit under outer amount column record 2,58,761. 2,58,767. 58,767. 2,58,000. Okay, done. This is problem number 4. So you come to problem number 6. Problem number 6 and problem number 4 are same sums, similar sums. Only one point is different thing. That is credit sales. Sorry, one second. See, credit sale here we studied 100% as credit sales. Here only 80% being credit sales. That's all. Remaining everything are same from problem number 4 and problem number 6. So problem number 6 is your homework. You can do it on your own. You can find the answer. Like if you want the answer, I will tell it. You can find it in the institute book. This problem number 6 answer. So you just do it in the same format what you did in problem number 4. Same sum. Here 100% sales is credit, whereas here only 80% is credit sales. That's all. Okay, with this we have completed problem number 4, problem number 6. Now come to problem number 7. Come to problem number 7. What is this problem number 7? This is one new concept, not new concept, same concept, but then new method. Concept is similar. You have to calculate the net benefit, but then you have to do it in different way. Okay. Problem number 7. SP are regular customers of GD Limited. SP is a individual. They are regular customers of GD Limited, Calcutta, GD Limit Calcutta, and have approached the sellers for the extension of credit facility. SP Limited has approached GD Limited for extension of credit facility for enabling them to purchase goods from GD Limited. That is, I am SP Limited and there is a GD Limited. I am SP and there is a GD Limited. I am the customer. I am going and asking GD Limited for extension of credit policy in order to purchase the goods from them. On the analysis of past performance, that is on the basis of performance which I did, that is on the basis of how I repaid my credit, the following pattern of payment schedule emerge in the regard to slow players. That is, they are giving in the following pattern. You can settle the amount in the following pattern. That is, at the end of, from the day of purchase, at the end of 30 days, you should pay 15%, 60 days 34%, 90 days 30%, at the end of 100 days, you should pay the 20%, and there is always a non-recovery of 1% of the bill. That is bad debt. And SP wants to enter into a firm commitment for purchase of 15 lakhs in 2012. I want to purchase 15 lakh rupees product, and deliveries to be made in each equal quantities on the first day of each quarter in the calendar year. The price per unit of the commodity is 1 lakh rupees 150. That is, each selling price is 150, on which profit of 5 per unit is expected to be made. That is, remaining 145 is the cost. It is anticipated by GD Limited that taking up this contract would mean an extra recurring expenditure of 5,000 per annum. Okay, I am incurring extra 5,000 expenditure in order to take up this credit. That is extension of credit. If the opportunity cost of the funds is handed hands of GD Limited is 24%. That is, opportunity cost lost on this investment is 24%. Would you, as the finance manager, you are the finance manager of the seller, that is GD Limited, recommend the grant of credit to SP? Working should form part of your answer. Simple. I am going and approaching GD Limited. I am asking for this. One second. I am asking for, see, I am going and approaching GD Limited. I am asking for credit extension, and GD Limited, what GD Limited is doing is it is asking its finance manager whether to accept or not the following credit. So this is how the problem should be solved. Take down problem number 7. Problem number 7. Statement number 1. Evaluation of credit policy. Evaluation of credit policy to SP Limited. Evaluation of credit policy to SP Limited. Below that, statement number 1, particulars. Below that, statement number 1, 2 columnar table, particulars, amount. Particulars, amount, 3 columnar table, particulars, amount, and amount. Evaluation of credit policy of SP Limited, particulars, amount, and amount. Below that, particulars, capital A. Below that, particulars, capital A. Incremental profit. Incremental profit. That is, because of accepting this offer, what is the profit I am getting? Totally 1,50,000, 15 lakh units I am asking. Okay, I am purchasing 15 lakh units. Each unit cost 150 rupees. 15 lakh units, 150 rupees divided by 150, that is 10,000 units. So below that incremental profit, small Roman number 1, number of units to be supplied. Number of units to be supplied. 15 lakhs divided by 150. 15 lakhs divided by 150. Inner amount column put 10,000. Below that small Roman number 2. Small Roman number 2, profit per unit. Profit per unit. Here, in the question itself, they have mentioned on which profit of 5 per unit is expected to be made. So, profit is 5 per unit. So, inner amount column record 5. So, now below that, small Roman number 3, small Roman number 3, incremental profit. Incremental profit, open a small bracket, small Roman number 1 into small Roman number 2. Small Roman number 1 into small Roman number 2. Outer Roman column record 10,000 into 5, that is 50,000. Outer Roman column record 50,000. Outer Roman column record 50,000. And leave one line gap, capital B, cost of credit facility. Cost of credit facility. Capital B, cost of credit facility. What are the different costs which are incurred for accepting this credit period? Small Roman number 1, incremental administrative cost. In the question itself, they have mentioned that incremental recurring expenditure of 5,000 per annum. So, small Roman number 1, incremental administrative cost, outer amount column record 5,000. Outer amount column record 5,000. Small Roman number 2, incremental bad debts. Incremental bad debts. Here itself, they have mentioned that non-recovery is 1% of the bill. So, below that, open a bracket, 15 lakhs into 1%. 15 lakhs into 1%. Outer amount column record 15,000. Outer amount column record 15,000. Below that, small Roman number 3. Below that, small Roman number 3. Incremental interest on debtors. Incremental interest on debtors. We are directly calculating the incremental interest on debtors because here they have not provided any old policy interest rates. Any old policy, under old policy, what is the period, that is not mentioned. They have directly given the what is the new credit policy that is going to be implemented. This is the incremental credit policy data. So we are directly calculating incremental interest on debtors. So below that, first arrow mark, at the end of 30 days, 15% of the bill. So first arrow mark, 15 lakhs into 15% into 30 divided by 365 into 24%. The return on investment expected is 24%. So inner amount column record 4,438. 4,438. Below that, second arrow mark. What is the second? 60 days, 34% of the bill. So 15 lakhs into 34% into 60 divided by 365 into 60 divided by 365 into 24%. 24%, which is 20,121. 20,121. And next 15 lakhs. Below that, third arrow mark, 15 lakhs into, for third one is 90 days, 30% of the bill. 15 lakhs into 30% into 90 divided by 365 into 24%, which is 26,630. 26,630. And the last arrow mark below that, 15 lakhs into 20%. 100 days, 20%. Into 20% into 100 days divided by 365 days into 24%. Inner amount column record 19,726. 19,726. Now total the inner amount column record outer amount column, that is 70,921. 70,921. See, you have calculated incremental interest on data based on the incremental data. This particular data is given only for SP Limited. This is not the credit policy of the company for all the customers. This is the credit policy only for the SP Limited. That is SP, only for him they are framing this credit period and they are giving him. So this is the incremental interest on debtors. On the other side, when 15% of the bill is paid on 30 days, so that 15% of the bill will have interest only for 30 days. So why we are calculating in the separate line. That is, for 50% bill only 30 days. For 34% of the bill 60 days. For 30% of the bill 90 days. And for 20% of the bill 100 days. And for remaining 1% you are not going to recover. That is what that 1% is actually calculated in the bad debts. So this is what incremental interest on debtors. So now total the cost of credit facility, that is 5,000 plus 15,000 plus 70,921, that is 90,951. What is this? 4,438 plus 20,121 plus 26,630 plus 19,726. That is 70,000. 4,438 plus 20,121 plus 26,630 plus 19,726. There will be point fractions differences. So they have calculated like 70,921. If we total it, it is coming around 70,915. Change it to 70,915. So total amount is 90,915. Below that, underline it, total 90,915. So cost of credit facility is 90,915. Now below that, capital C net benefit. Open a bracket, capital A minus capital B. Now calculate the net benefit. Capital A is 50,000 minus 90,915. That is 40,915. Within bracket 40,000, negative balance of 40,915. Within bracket 40,915. So it is going in negative. So it is not advisable to accept the proposal. So below that, record the comment. Comment: incremental net benefit is negative. Incremental net benefit is negative. So it is not advisable. So it is not advisable to extend the credit facility to SP Limited. To extend the credit facility to SP Limited. To extend the credit facility to SP Limited. So with this we have completed. Oh, come here. This problem number 5. Mark this problem number 5. I have to work it out because there is no print answers for this. So I'll work it out and I'll give it in a few further classes. Like in the end, we'll just finish off all the leftover sums. You just write here remaining. That record that problem number 5 is remaining. Okay. Problem number 5 is remaining. With this, we have completed receivables management unit number 2. So now we'll just finish off this unit 3 and wind up the class in this particular class. See, unit 3 is very simple: cash management. Cash management, it is similar to EOQ, which you studied there. Like economic order quantity, you would have studied in costing in group 1, I think so. Economic order quantity, costing or finance, something, economic order quantity in costing. So the same method is going to be applied here in cash management. Only one sum they have given, and basically this chapter they are not throwing sums, but you just know what is their concept, and only one sum is there. We'll just finish it off. So cash management is nothing but it is maintenance of cash. The management which has been set up to maintain the cash. It will take manage whether all the cash flows into and out of the firm, and cash flows into within the firm, and cash balances held by the firm. So all these are different management aspects of this cash management. They will handle all the cash activities. That is, how much is coming in, how much is going out, and within the firm itself is how much is being exchanged, and how much balance is held by the firm on the particular day, whether we are having surplus or deficit. All these are managed by the cash management. So objective of the cash management is to ensure that whether they have sufficient cash balance, and to ensure the liquidity, because cash is the most liquid asset. So if there is no cash, immediate cash for the payment, then they'll face these liquidity issues. And next is to identify whether they have surplus funds or deficit funds, and to invest the surplus funds. If they have some, maintaining the cash management will help them to identify whether they have surplus and to use that surplus funds in some investments. short-term investment. So these are the different benefits of this cash management. So motives of holding cash is to do transaction day to day, and to investment, speculative investments like short-term investments they'll do in order to get short-term surpluses, and precautionary and safety needs. That is, they maintain some balance in cash because they don't know what will occur immediately. Like there will be some safety needs, so precautionary measures. So they'll handle, they'll have some cash in hand. So basically, this optimum level of cash only that is calculated by EOQ model. It is also known as EOQ model. Same quantity, how much quantity should be maintained is equal to square root of 2AO by C, where Q is optimum level of cash. How much cash should be maintained? A is total amount of transaction demand. That is in a particular year, how much amount of transaction is demanded. And O is average fixed cost of securing cash from the market. That is transaction cost. For every transaction, how much is the cost you are incurring? And C is cost of carrying cost. That is, suppose you are having it in your hand, cash. What is the interest rate which you are losing on that opportunity cost? So that is the cost of carrying cash. So that is C. 2AO by C. Square root of 2AO by C. That is the optimum level of cash. So simple. This is the problem. There's only one problem. Same method 2AO. What will do EOQ 2AO by C? Same formula, same method we are going to apply here. Just take down problem number one. Problem number one. UI Limited projects that cash outflows of 37,50,000 will occur uniformly throughout the coming year. So total cash occurrence, that is A is 37,50,000. UI plans to meet the cash requirements by periodically selling marketable securities from its portfolio. So the firm's marketable portfolio are invested to earn 12%, and cost per transaction of converting securities into cash is 40. That is, see, instead of having it in cash, even the liquid asset, you can hold it in some liquid securities like marketable securities, where immediately if you want, you can sell that security and take the cash and pay the expenses. So cash should not be kept as cash. That is the first important thing, because this is inflationary time. That is, not only this, every time, every period is an inflationary period where money will lose its value when time process, like when time progresses, money will lose its value. Instead of keeping the amount as cash in the locker, you can keep it in your bank account and you can utilize it for some short-term securities like marketable securities to earn some 12% return. See, in this problem they have given 12% return, that is 1% per month, so that you can earn from this cash balance maintained. So interest amount is 12%, and C, that is for transaction cost, that is 40 rupees. O is 40 and 12% return is interest rate is 12% return. So using this use the Baumol model, that is EOQ model, to determine the optimal transaction size of marketable securities to cash. How much transaction size, that is for each transaction, how much amount should be transferred. That is the EOQ model. For that, EOQ model is used. And what is the company's average cash balance, which can be calculated by multiplying the average cash balance can be calculated by dividing the optimum transaction size divided by 2. That is the average cash balance to be maintained. And how many transfers per year will be required is annual requirement. That is total A, 37,50,000 divided by what is the transaction size which you are finding. That is EOQ, which we are finding Q, that should be divided. So using this, we should calculate the using the formulas, we should calculate the answer. Now put that in unit 3. Unit 3, cash management. Problem number 1. Problem number 1, small a, optimum transaction size. Small a, what they are asking us to find optimum transaction size, that is Q. Within bracket, write Q. What is Q? Square root of 2A O by C. So A is annual requirement. A, below that A is equal to annual requirement is equal to how much is the annual requirement? 37,50,000. So record 37,50,000. And O equal to transaction cost. What is the transaction cost? Here 40 rupees. So O equal to transaction cost is equal to rupees 40. Rupees 40. And C hyphen interest rate. C is the interest rate. How much is the interest rate? 12%, that is 0.12. C interest rate is equal to 0.12. Now total it, like write the formula is equal to, below that write the formula square root of 2AO by C. Square root of 2AO by C. Now calculate it. 2 into 37,50,000 into 40 divided by 12%, and square root of it is 50,000. So is equal to rupees 50,000. Rupees 50,000. So point number A, this answer is 50,000. Annual transaction, optimum transaction size is 50,000. Below that, small b. Small b, they are asking average cash balance. So the formula for average cash balance to be maintained is optimum transaction size divided by 2. Optimum transaction size divided by 2 is equal to rupees 50,000 divided by 2. That is equal to rupees 25,000. 50,000 divided by 2, that is 25,000. Optimum transaction size is 50,000 divided by 2. Formula itself is optimum transaction size divided by 2. You just remember these formulas. Optimum transaction size is square root of 2AO by C. Then average cash balance is optimum transaction size divided by 2. And point number C, how many transfers per year will be required? Small c, below that small c, number of transfers per annum is equal to annual requirement divided by transaction size. Annual requirement divided by transaction size. Annual requirement divided by transaction size. Below that, what is the annual requirement? 37 lakh 50,000. What is the transaction size? 50,000. So 37 lakh 50,000 divided by 50,000 is equal to 75 transactions. 75 transactions. Total number of transactions is 75 transactions. And last one is, what will be the total annual cost of maintaining the cash balance? So what is the total cost incurred for maintaining this cash balance is, you should do 75 transactions. Okay, for the 75 transaction, each transaction 40 rupees is taking. So 75 into 40 is one cost. And one more thing is total interest cost. You should maintain 25,000 as average cash balance. So on that 12%. So that is the cost you have been incurred. Interest cost is nothing but you forgone that cost, 25,000. So these two are the cost incurred for maintaining the cash balance. So small roman number D. Below that, small roman number D, calculation of annual cost of maintaining cash balance. Calculation of annual cost of maintaining cash balance. Below that, two column table, first column particulars and second column amount. First column particulars and second column amount. Under particulars, small roman number A, total transaction cost. Total transaction cost, that is number of transactions is 75 and transaction cost per unit is 40. So 75 within bracket 75 into 40. Amount column record 3,000. Amount column record 3,000. Below that, small roman number B, total interest cost. Total interest cost within bracket 25,000 into 12%. 25,000 into 12%. What is this 25,000? You are losing that interest amount on this 25,000 because you should maintain an average balance of 25,000. The amount of loss due to converting it into cash. Like every month, like 40 transactions you are doing, 25,000 should be average cash balance you should maintain, so that you are losing that interest amount on that 25,000. So within bracket 25,000 into 12%, amount column record 3,000. So total 6,000. So 6,000 is the total annual cost of maintaining the cash balance. Total annual cost of maintaining cash balance. So with this, we have completed the cash management. So this chapter number 5, that is working capital management, is over. So from next video, we'll start off the next chapter. Thank you.